Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures, little change this morning as investors are digesting the latest read on the economy with jobless claims as well as earnings. Now, Qualcomm, ARM, and Ford sliding after disappointing to the downside after the closing bell. Investors also watching Eli Lilly, Roblox, Hershey, and a slew of other results out this morning.
Plus, traders also closely monitoring and reacting to the commentary that we got from Treasury Secretary Scott Bessent, who said that the White House is focused on lower Treasury yields, not Fed rate cuts. Bessent believing that expanding energy supply is going to lower inflation, also that reducing the budget deficit is going to help bring down 10-year yields.
And e-commerce giant out with results. Amazon. After the closing bell tonight, you're going to hear from that company and their spending plans, and AWS performance will be the main focus of its upcoming results, with investors seeking margin improvement and revenue growth amid heavy AI infrastructure investments.
Let's get a check-in on the markets here. We're just about 29 minutes until the opening bell. You're now looking at a positive picture for the major averages, although much of the morning futures have been searching for direction as investors do digest the commentary that we got yesterday from Treasury Secretary Scott Bessent. That's having a real impact on the bond market here. If we want to flip over to yields and see a bit of the downward pressure that we have been seeing, you have the 10-year yield right around the lowest level that we've seen in about a month. Here we are this morning, right around that 4.42. Questions about whether or not we could actually break below that 4.4 level. So again, very much the focus here for investors when you take a look at the bond market. And then also driving this morning's reaction is a couple of those earnings reports that Brad just mentioned at the top there. Qualcomm obviously falling just about 5%, I believe, in pre-market trading. Some questions there. Then you have Ford, Skyworks, Honeywell, the report out there, or confirmation that the company is going to be splitting into separately publicly traded companies. That, of course, coming following some activist investor pressure there, and that's having some impact here on the broader market. But again, the three names up on your screen, some of those earnings results, all moving to the downside and dampening maybe some of that sentiment out this morning.
Yeah, more largely I think about the thread that I've been drawing between some of the outlooks and the overall kind of gauge that we've seen even from UBS as they've continued to kind of update their own view here week over week. And for two consecutive weeks, essentially what they were calling out was growth despite tariffs. And then this week we got an update that came in and ultimately said, okay, well, uncertainty remains high. So the tariffs continue to ratchet up the uncertainty. But because of the tit for tat and how that will play off, I think that's where it remains top of mind for investors, regardless of what we hear from the economic data, regardless of what we hear from some companies as they report earnings. All investors want to hear about how these companies are talking about policy at this point. And so that's something that remains top of mind for investors and for executives as they're navigating through some of the earnings calls as well. And we've seen tariffs once again ratchet higher in the number of mentions that we've seen over the course of this earnings period. But just to put a fine point on this and UBS and how they were talking about this, they believe the most likely outcome is for solid economic growth despite tariffs. That perhaps some good news for the Fed here. U.S. growth momentum currently strong, and then they continue to believe the Federal Reserve will cut interest rates in 2025 all in by 50 basis points. We'll see how that gets revised going forward from here, especially even as they week over week adjusted to say uncertainty remains high this week, and they're looking across diversification and hedging approaches. And I think that's what you're seeing play out within these futures even this morning here. Investors searching for direction, looking for hedges at this point in the market as well. Let's break it all down further with our own Josh Schaefer here. And Josh, you've been tracking since you came into the newsroom this morning saying, all right, there's not a ton of movement this morning, but ultimately we're still here.
There's something to be excited about.
Some days futures are just kind of flat, right, Brad?
Yeah.
That's okay.
Yeah.
We'll get some movement once the trading session starts, I'm sure. But I think the biggest thing I was watching sort of overnight into this morning is what Shauna was referencing with how the administration's talking about watching the 10-year yield rather than the Fed in terms of interest rates, and thinking about why we normally, or how we're normally watching the 10-year yield in terms of the economy, right? And sort of how economic data will move that 10-year yield. Of course, the administration essentially saying that they feel like they want 10-year yields to come lower, right? So what would bring 10-year yields lower? Probably some version of soft economic data, right? If we look ahead to tomorrow's January jobs report, typically hot reports have sort of sent yields a little bit higher, right? Sparked a bond market sell-off. So that will be something to watch going into tomorrow. But one thing I was writing about, Shauna, this morning was we keep talking about the stable labor market, right? And sort of what can change that narrative. It's been a lot of low hire, low fire, things are okay if you have a job. That's sort of been the labor market vibe for, feels like 6 months now. And I asked Neela Richardson, what could, she's ADP's chief economist, what could kind of change that? She pointed to inflation, which I thought was interesting and sort of reminded me that every conversation still feels like it comes back to inflation. Her point being, right now, a lot of the sectors that are leading the gains in the jobs market are consumer-facing sectors. So if you get a period or resurgence of inflation off of these tariff policies, off of really anything, it could hurt the consumer, then hurt hiring. Maybe that's how you get your labor market slow down. But net, the question continues to be, what will slow down the labor market that is moving relatively steady at this point?
And I wonder how worried she is about the inflation picture right now, just in terms of that narrative, that rhetoric changing almost daily here when it comes to the latest updates that we're getting from the White House, even on the street very much. They still have it in their view, but not so much calculating or incorporating it, I don't think, into their models as of yet. We've gotten some of these worst case scenarios, our discussion with Matthew Lazzetti not too long ago, just about maybe what that upside pressure could potentially look like. But I guess the question is, how much of an uptick do we need to see in order to see maybe some of that deterioration?
Yeah, I mean, just talking specifically about what Matt had said, Matt would point to about 3% on PCE, right? And you're looking at a year-over-year PCE at 2.8, so you'd have to move up a little bit. And I think part of what Neela was talking about is what Fairshare Apparel talks about, which is inflation, but also inflation expectations, right? So expectations started to tick up a little bit, haven't moved up significantly. And then to your point on the actual data shifting higher, that's not really where the story is right now. It's just coming down slower than it was. So it seems like it would take several months for that to play out, right? For us as consumers to realize, oh, inflation's going back up, I have less money than I thought, I'm going to spend less. That's a trickle down that would take a little bit, but still could come eventually. I think overall, it's just hard to paint different pictures of what's going to really deteriorate the labor market at this point. So we're kind of trying to find a needle in a haystack when it comes to that story.
Well, and going sector by sector, two of the ones that she called out as we had her on yesterday was manufacturing and construction. Those both seeing declines, signaling a shift in the labor market, she told us on Yahoo Finance as well. And if you want to know everything that you need to know about the labor market, follow the consumer, coming back to your discussion with her. And we, on top of that, got jobless claims info out this morning, which came in, a smidge hotter than expectations, but that number, that print, 219,000 jobs that were lost during the month, the prior reading here, that is now running above the 4-week average. And so that is something that, if we're looking for cracks in the labor market, that's something that could be more of a pulsing precursor here.
Continuing claims also moving higher too, Brad, right? And that shows us how long it's taking employees to find a new job. And right now it's taking a little bit longer. I saw one economist from Oxford Economics today sort of saying that might be most related to tariffs, right? And what you were talking about with the uncertainty around policy, it might be harder for the hiring environment for people to be willing to hire new employees. Then it takes longer for people to find jobs. Again, if we extrapolate that out and that environment lasts a while, perhaps you get into a little bit of a challenge there for economic growth at some point.
All right, Josh, thanks so much. Well, the 10-year Treasury yield hovering around the lowest level that we've seen in just about a month, following some commentary that we got from Treasury Secretary Scott Bessent. He spoke with Fox Business yesterday, saying that President Trump is, quote, not calling on the Fed to lower rates. They're not worried, not focused on what the Fed is doing, but rather they are focused on the 10-year Treasury yield. For more on this, I want to bring in Ed Mills. He's the managing director at Raymond James. Ed, it's great to have you back here on Yahoo Finance. So certainly some of that rhetoric and some of the comments that we got from Bessent certainly had and do continue to move the market here this morning. My question to you is, when you take into account what the administration wants to see happen, they want to see lower yields. Is that possible given the policies, especially the tariff policies that are and do seem to be coming out of the administration?
Yeah, Shauna, it's an important question. And I do think that when we look at the Hill and what they want to do on tax cuts, another really important thing that came out of that interview yesterday was a continued insistence by the Treasury Secretary that the Trump tax cuts from 2017 are going to be made permanent. To do that, that adds more than $4 trillion to the debt and deficit over the next 10 years. There is also a desire to go beyond that. No tax on tips, no tax on Social Security, overtime, changes to SALT. Now we're more than $5 trillion. If we see a bill that would add to the debt and deficit by more than $5 trillion, it is going to be a challenge to keep the long end of the curve down. One of the things that I would also look at, Shauna, is if there is something that the Treasury Secretary has some authority over versus the Fed funds rate, is Treasury yields. And what we saw over the last couple of years is under the Biden administration, Treasury Secretary Yellen changing the way in which they refunded treasuries that put downward pressure on the 10-year that allowed for us to seem as if inflation was not running as hot. Can they continue that? My bet is they actually have to issue more 10-year treasuries, which will be a difficult part of keeping that lid on the long end of the curve.
And so, Ed, what are the potential offsets if this is seen as a move that would ultimately move the deficit higher?
Brad, when I've been talking to clients at Raymond James, this week in particular, we've seen a very aggressive action by Elon Musk and Doge. If bondholders think that there is going to be less government spending and a material impact on government spending, that they have a higher probability that the kind of fiscal picture of the United States is looking better. We had Donald Trump talking about the establishment of the ERS, the External Revenue Service, through the collection of tariffs. If tariff policy is going to bring in more cash to the United States government, that would be viewed as positive for bondholders. And then finally, if there are parts of the deregulatory agenda, if there is more energy exploration, that should promote economic growth. So what you would hear from the Trump team is those things in combination, Brad, would help bondholders get more optimistic about the future fiscal path of the United States, and therefore bond yields should reflect that.
And I guess my question to you is, when you take a look at Bessent's 3-3-3 plan, and a lot of what he laid out at Fox Business is very similar to what we heard from him over the last several weeks, just in terms of his priorities and what he likes or what he would want to see happen. How much of that is more so sentiment driven versus a material shift that we're going to see on inflation?
It's a to be determined situation. And I would add to that, Shauna, is sentiment is going to be driven by the process in the pace of which President Trump and his administration does things. If we get more of the tariffs, more of the kind of tax cuts early, and we're not getting that energy exploration, we're not seeing a change in energy prices, or we're not seeing the deregulation, sentiment's going to be pretty mixed on this. They are trying to use the bully pulpit of the presidency to get this done. And I think that they have a shot at this. When I've talked to investors at Raymond James, people are cautiously optimistic about the path forward this year with the market. Probably the thing that they are concerned about is the return to volatility that we've already seen. And we didn't have much volatility the last couple of years, but with the policy uncertainty brings that back to the forefront.
Ed, as you evaluate some of the kind of geopolitical uncertainty as well, and the tit-for-tat tariff talk that has started to emerge as of this week, and of course has been prioritized since the campaign trails, how do you look at some of the technological portions as political or even geopolitical pawns as a part of this, thinking about DeepSeek, thinking about TikTok, and how that could potentially continue to get ratcheted into the conversation?
So here at Raymond James, for the last 5 years, Brad, we've been talking about one of the biggest changes in U.S. policy is how we have now viewed our technology as a national security asset. That started first and foremost with semiconductors, semi-cap equipment that was going into China. It expanded to AI. We also expect it to expand to energy resources. Think about the critical minerals, the rare earth minerals. I'm seeing things in the Biden administration start that Trump is picking up on in his executive order, saying we need to de-risk these supply chains. I've seen things in healthcare, the biopharmaceutical concerns, active pharmaceutical ingredients. We see Trade Representative Peter Navarro talking about healthcare as this next frontier. And so for Donald Trump, if there is something that the United States has that others want, and if our enemies want it in particular, he's going to seek to restrict that and protect the U.S. position on that. and there's been market volatility tied to that. I've had so many conversations at Raymond James with semiconductor analysts. I just know I'm going to expand that group as that export controls expands in Trump 2.0, Brad.
And when you take a look at the news that we're getting out this morning here from D.C., President Trump said to meet with GOP lawmakers on this budget resolution. Time is ticking. Lots of questions about what the next couple of weeks is going to how the next couple of weeks are going to unfold, how likely it is that we are going to get any sort of resolution. You've called it the fact that we're likely on track for some sort of collision course. What does that look like? What's the fallout?
Yeah, so the first collision course that I'm looking for, Shauna, is March 14th. The government needs to be funded by March 14th. The debt limit, we've already started extraordinary measures. That needs to be dealt with. That only can be done on a bipartisan basis because you still need 60 votes in the Senate to get that done. And with the small majority in the House, there's no way, in my mind, House Republicans can coalesce over lifting the debt limit. Some of them just will never vote for that. You have a need to fund wildfires and other disaster relief. But then you have the Trump administration saying, look, what you pass in Congress is not what I am beholden to. That might be a ceiling, not a floor. And you have Elon Musk and the Doge Committee going agency to agency, looking to kind of massively cut budgets. So if you're a congressional Democrat and you're looking at these budget negotiations, why would you get a hard-fought win that can be reversed the next day by Donald Trump? And so I think the threat of a government shutdown is actually pretty high come March 14th. What we can do with the debt limit becomes in doubt. And the longer we're under the debt limit, it might be Scott Bessent's wish, because what we saw in 23 is that the longer we're under the debt limit, the more pressure was on long-term yields. Mm-hmm. But once we lifted that debt limit, we had to issue a bunch of treasuries and yields spiked higher. So it might be short-term benefits to long-term pain, and a huge distrust right now, Shauna, between congressional Democrats in this Trump administration. I'm sure it can go lower, but it's hard to see it much lower than it is right now.
I agree with you there. All right, Ed Mills, great stuff. Thanks so much for taking the time to join us.
Thank you.
As we head to break, let's take a look at shares of Amazon. The company set to report earnings after the bell this afternoon. They're expected to report revenue growing 10% in the fourth quarter. Lots of focus on the cloud business, advertising business, AI spending, and of course how that's paying off for AWS. That is going to be a key thing in this report here tonight. You're looking at shares up just about 0.7% ahead of the open. We'll be right back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Eli Lilly reporting earnings for the fourth quarter of 2024 in line with the street's expectations. Sales of the drug maker's weight loss drugs Mounjaro and Zepbound coming in slightly higher or lighter than analysts expected, but in line with Eli Lilly's estimates from earlier this month. Joining us now with more on the drug maker, we've got Jared Holtz, who is the Mizuho Healthcare Equity Strategist. Jared, good to have you on the program with us this morning. Just want to get your read in on Eli Lilly and the forecast that they're putting forward for 2025.
Thanks a lot for having me. Yeah, I think the forecast is fine. I think basically right in line with street expectations for the most part in terms of revenue, guiding EPS ahead. I know there are some analysts who thought earnings could even be higher. I'm sure they're reinvesting a lot of this back into the business for pipeline opportunities, et cetera. But I think when you see the totality of the numbers, I thought they were fairly strong.
Jared, when you take a look at what's next here for Eli Lilly, lots of questions about inventory issues, what some of the progress looks like there, what pricing is going to look like for some of these weight loss drugs, especially when you look ahead to 2027. How are you factoring that in?
Well, I think from a manufacturing standpoint, I really wouldn't want to be anyone other than Lilly or Novo at this point, when you can kind of consider how much they've invested behind CapEx and the supply chain, logistics, all those items. It's been overwhelming. I mean, over $30 billion invested over the past couple of years. So I'm really not concerned about manufacturing. I'm not really concerned about supply demand. I think demand is still incredibly high. Can they get enough drug to each patient in any particular quarter to kind of satisfy investors? I think that's the debatable topic. But as we move over the next couple of years into 2027, 28, when pricing gets a little bit trickier, I still think this is going to be either player 1A or player 1B, depending on the quarter in obesity.
It wouldn't be, of course, the Eli Lilly conversation if we didn't acknowledge the oral pill, orforglipron, which in itself sounds like it comes straight out of Narnia. But all these things considered, how quickly they're able to get that to market and what type of demand they're expecting to kind of normalize the run rate for the demand that we've seen across GLP-1s. How are you evaluating that? What does that kind of normalization look like long term?
Well, no one knows. I think the toughest part about getting the modeling right or getting the forecasting right is just understanding how long each patient is going to be on the drug for. And I don't really think that's an exercise that anyone can predict with certainty. And as we move over the next couple of years, we're going to be faced with, a whole variety of other competitors, whether it's coming from Lilly or Novo or for another company. I think the orals are going to be a massive market opportunity insofar as the data from a safety standpoint is pretty good. I'm in the category, I think that the orals are going to essentially support the injectables and be used more for maintenance therapy. I don't think we're going to be able to get that much weight loss in a single pill. But for patients who have been very successful on the injectable already, I don't know why they wouldn't take a single pill every day to make sure they maintain their weight. So I think as we look at the markets, that's really where these things are going to fit in.
Jared, what's the efficacy threshold, do you think, in order for that to work?
I think anything north of 10% for me for a pill would be pretty good. I know other analysts are out there and companies are saying 15%. I'm not really sure we need that. And the reason for that is look at what's happening in the GLP market already. Patients are fine losing 15 to 20% of their weight. I don't think there's a desire for the majority of the bell curve in this market to lose more than that. So I think from an oral, if you can lose around 10%, and obviously that's going to work in a maintenance market as well. You could have patients who take this as a first-line therapy. You could have patients who take this adjunctively to an injectable. It's a huge opportunity.
Just lastly, while we have you here, Jared, we also got results from Bristol-Myers Squibb this morning, missing estimates for its full year 2025 sales and earnings and saying it plans to cut an additional $2 billion in costs by 2027. As we're taking a look at shares right now, they are down by 4% pre-market. Jared, just want to get your read in here with the cost cutting and with the outlook that this company has put forward.
Yeah, I mean, the stock's been on a major run really since the summer of last year. Essentially driven by one drug or one product that was acquired from Karuna treating schizophrenia patients. The rest of the business is very, very similar to how it was at the beginning of last year. So year over year, I think you're still looking at a company where the majority of sales are going to see degradation into 2030, and there really isn't that much of a pipeline beyond the one drug that they acquired. I think today's move is really a reflection of some of that coming back into the forefront, and investors looking at this as a company that still has a lot of issues with respect to revenue. So not that surprised by the move here. I think from low 40s to high 50s, mainly driven by one drug, and I just don't think that's enough.
All right, Jared, thanks so much for taking the time.
Thank you.
Take a look at another trending ticker that we're watching, and that's Honeywell. Shares on the move after the company confirmed plans to split into three separate businesses: Honeywell Automation, Honeywell Aerospace, and Advanced Materials. This coming after pressure from activist investor Elliott Management. You're looking at losses here in shares of off just about 2.6% here. But ultimately, what this means, the formation here of three independent companies, the CEO saying that industry-leading companies is going to build on the powerful foundation that we have created, further positioning each to pursue tailored growth strategies, unlock significant value for shareholders and for customers. Although you are looking at shares, like I said, under a bit of pressure here this morning. And this was largely, I think, maybe expected here, just in terms of the changes that would potentially happen, especially on the heels of the activist investor activity, especially from Elliott. Obviously, just the force that they have and typically have and the impact that they have on these companies that they do target. But again, the fact that they are splitting into three companies here, we're at least seeing initial pressure on sales here, but the CEO very much making the argument that this is going to set up Honeywell better for the future, a more streamlined business.
Yeah, they say here that the planned separation, coupled with this previously announced plan to spin off their advanced materials, will result in those three publicly listed industry leaders, distinct strategies, different growth drivers, and the separation is intended to be completed in the second half of 2026 here. And they're looking for this to be, they add tax-free to Honeywell shareholders here. The formation of this, they're also mentioning, is about a simplification of their business here. Of course, coming back to that pressure from the activist campaign that you were mentioning a moment ago. We should also mention this most recent quarter, sales for the fourth quarter were actually up 7% on a year-over-year basis there. So did see some improvement on that scale.
Yeah, and the CEO talking to Brian Sazzi at Davos just a few weeks ago, talking about the fact that the biggest change here that he is driving is how to make it a growth-oriented company, very much making the argument that this move does in fact do so. We'll be right back with the opening bell. We got the opening bell here on Wall Street. Let's do a check of the markets here with the major averages. We've been waffling pretty much in pre-market trading, searching for direction for the three major averages as the market does react and digest to the commentary coming out from Scott Bessent. What the administration wants to do is focus on lowering yields and also squaring that with some mixed results, earnings results that we are getting out this morning. So here we are in the early trade. You've got the Dow up on an intraday basis, adding to some of those initial gains here. When you take a look at the S&P 500 popping just about 0.2% as we take a look at the big numbers here. You've got the Nasdaq Composite calibrating here as we speak, but you're looking at gains here, slight gains at the open. Taking a look at the bond market, since much of the movement has been there, you're actually taking a look at it move slightly higher right now at 444, but not too far from those 1 month low levels that we are hovering at here. And taking a look inside some of that sector action here this morning, I mentioned the fact that we're getting a mixed picture here from earnings. You're seeing that reflected in some of the early sector movement this morning. You got consumer staples, financials among the outperformers here. Lagging is technology and healthcare. Again, when you dive into some of these results that we are getting here this morning, taking a look inside the Nasdaq at some of those larger cap tech companies, we're going to be getting results from Amazon after the bell. That, of course, is going to be one of the big focuses here as we look ahead to the closing bell on the street, of course, surrounding the focus that we have seen on AI spending. Look at Amazon up just about 0.7%. Nvidia also adding to yesterday's gains, up another 1.3% here in early action. You've also got Microsoft in the green here as well. As we flip over to some of the trending tickers here on Yahoo Finance and take a look at some of the earnings names and really what is driving that sentiment. We also heard from Qualcomm and from ARM out after the bell yesterday. I want to pull up Qualcomm, just the degree and the extent of some of the selling that we're seeing here. You can see that up on the right-hand side of the screen right here, it's off just about 5.5%. If you take a look at a longer term chart and take a look at a 3-month chart here for Qualcomm, lots of questions just about what supply and demand are going to look like here for phones, for smartphones, and you're looking at weighing on a Qualcomm's overall picture right now. You're looking at shares off just about 3.8% over the last 3 months. Again, this morning's action, though, the stock off just about 5.5%. Jared Blickery standing by with a closer look at some of that movement that we're seeing. Jared.
Thank you, Shauna. I want to start with the indices. We are looking at potentially the third straight day of gains, and this is a 3-month chart. So this is a Dow, and this is going back basically to the beginning of November, and you can see kind of, it's been kind of sideways since then, and that includes some of the election reaction that we saw in that early November period, but it's been back and forth. And yesterday, by the way, was a very quiet day in terms of market volume, uncharacteristically so, not making too much of it, but as stocks are close to their record highs, here's the S&P 500. You can see a lot of sideways action there, though it's at the upper end of this range. We're looking for that catalyst, that next catalyst to push through potentially to that upper level or send it back down and test the lower end. So that's what we're waiting for here. The dollar index, which had been down 3 days straight, is now up. So it looks like it's snapping that streak. Importantly, it is off of these highs here, well off those highs. So that gives some relief to the risk rally that we have. We've been covering that. And I want to draw our attention to what's happening in sector action. Shauna already pointed out that Staples is leading today. I want to look at the year-to-date totals because as of the close yesterday, healthcare had edged out financials for the best position in the year-to-date. And you can see it's holding that this morning. Healthcare under a little bit of pressure, but it is now up 7.8% on the year, and that is versus 7.5% for the financials. Where's tech in the mix? Tech is barely there. Oh, it just disappeared. Here we go. It is up 0.7%, and the S&P, by the way, is up 3.3%. Everything in the green here, but it is a different mix and a different quality of the rally that we have seen this year as compared to previous years in this bull market. And I think that's worth underscoring here. Materials, communication services, energy, and industrials round out the top row. So that's a pretty non-tech robust offering here that we have in this bull market, and we've seen that rotation take place. Speaking of rotation, there's rotation out, and this is year to date. So let me put this on the intraday. We're seeing rotation out of Apple, Alphabet, and Tesla today, just slightly, but we're seeing some money flow into Nvidia, Microsoft, Meta, and Amazon, all those mega caps doing well. And I want to head over to futures land where I've been tracking copper. Now, now. Copper is just breaking out, and the symbol there is HG equals F. We'll see if I can find that on our board here, and failing that, I'll just say, oh, there we go. It's up 0.11% today. Here is a one-year chart, and it's hard to see here, but it has just exceeded this high that we had from January. So now it is tracking the highest level since about September, October. And I'll put that line chart back there so you can see it. There are the highs that we're talking about. So copper's on a run. That has very important industrial applications, or I guess for the market, and people call it Dr. Copper for a reason. So we will pay particular attention to that, especially as a lot of investors are saying, well, this is the year that China wakes up. I think copper is going to be an important bellwether for that action if China actually does wake up. Here's Bitcoin doing a big fat nothing, but it is holding under 100,000, 98,500. Want to mention that this is entering a very bullish time of year for Bitcoin, February to May. That's Jeff Hirsch, his work over at the Almanac Trader. So seasonally bullish period of time for Bitcoin over the next 3 months. We'll have to see if it works out, Brad.
All right, we will indeed. Jared, thanks so much for the setup going into today's trading activity as we kick things off. It's time now for today's strategy session. The next of the Magnificent Seven to report will be Amazon. That's out after the bell tonight. Can the e-commerce company continue to lead its peers as its peers face pressure on CapEx spending? Joining us now, we've got Michelle Snyder, who is the MarketGauge.com chief strategist. Michelle, great to have you here with us. So let's break this down and the setup from Amazon that you're seeing coming into the earnings report later today.
Well, as far as Amazon goes, I mean, from a consumer standpoint, as much as I almost hate myself for doing it, me and clearly millions of others are using Amazon because it's still really not only the most reliable place to get goods, but also one of the cheapest place to get goods. And so I don't see any reason like Costco, which has done very well after reporting and now is trading over $1,000, that Amazon can't continue. Of course, what would stop that would have to be something really drastic like major recession or what have you, but I don't see that. So for now, I'm not in Amazon, but I definitely would not be bearish. And we could have a situation like we've been seeing in some of the other earnings where they beat and then it actually has an opposite reaction and the after hours being down and then turns around the next day. I wouldn't be surprised, but probably be a good dip buy if it happened.
Mish, what do you think of the valuation concerns when it comes to big tech? Obviously, profit growth is slowing, expected to slow even further here in the coming quarters, putting into question some of those lofty valuations that we do see across the board when it comes to big tech. What does a reset of that potentially look like?
Well, we've heard a lot about CapEx, right? The capital expenditures going up, which of course always hits the bottom line in terms of profits. And that's been the classic example of the earnings being really, really good, the guidelines for the future still being good, but yet also the capital expenditures also rising. And that's why we're seeing some volatility in those stocks. So I'd say for me personally, it's one thing if people are already in position, but that is not really where I think the money is to be made right now. We can just see that reflected in the price and the overall broadening of the market into other areas that I think is pretty exciting and probably more worthwhile in terms of profitability and percentages of rising prices.
If there is perhaps this ability that investors are looking for in order to relieve some of their dependency on this long Mag 7 trade, where are the first beneficiaries elsewhere in the market?
Well, let's talk about commodities because it's not talked about very much. I heard Jared talk about copper, so that's certainly a commodity, and that's something to be watched. We have had a spectacular run in gold and silver, and even though they're relaxed a little bit here on the opening, the potential, particularly from now, a supply side in gold with miners going up, presents an opportunity. We've been seeing it in food prices with corn, soybeans, wheat, all looking like they're basing out. I'd probably stay away more from the energy space. And then sugar, you know, I look at that not necessarily as an investment, but as a barometer for what could happen in terms of inflation and rising food prices in the future. And that's also popped up pretty significantly, flirting with around 20 cents a pound. So that's one area. But then we also have to look at my Modern Family, which I'm excited. They're happy this year. Small caps, IWM is outperforming. We're looking at the retail sector. Looks like that could actually, whether it's be on staples or consumer discretionary, which has been weaker, could also really participate and is already participating. I know we have sentiment tomorrow. Biotech has relaxed a little bit, but there's been a lot of areas in there. Transportation's been the weakness in the family, and I think maybe unless that really accelerates to the upside and gets back over, if we're looking at IYT 70, could be the little sticking point in the euphoria that we're seeing in the Modern Family. But yeah, those are broadening.
When it comes over to small caps and retail trade and some of the other broadening out that you were just talking about, doesn't the tariff story, doesn't that put that then at risk?
Absolutely. But one thing I've learned this year, and I learned in 2017 as well, is that you have to follow price because the price is going to dictate the narrative. So yes, tariffs are scary, but if you're looking around at certain things, they're going higher in spite of, and some aren't. So I think to be safe, we want to look at things in terms of whatever it is, whether it's small caps or retail or what have you, but that's more US centric. And I think that's really what the market's trying to tell us here. So that's why I'm broadening out. If I'm looking at biotech, and I was watching before when you had the gentleman talking about Eli Lilly, I'm looking at the vanity trade. I'm looking at Novo Nordisk and AbbVie in that space. If I'm looking at the car space, I'm looking at Rivian because it's in the United States. Even Ford got crushed, but Rivian's still holding up well. We're looking at AI. I'm still looking more at the software side and even the quantum computing side. So you have to, this is a stock picker's market. When people say that, it's true. And the key, Shauna, in that is really to look at the chart setup. If it's accelerating in the uncertainty, then that's a good sign.
All right, Michelle Schneider, always great to get your insight. Thanks so much for taking the time to join us here at the Open. It's time now for a chart of the day. Let's send it over to Catalyst co-host Madison Mills for a look at trade tensions and the impact there on inflation. Maddie.
That's right, Shauna. Taking a look at the big question, do more tariffs necessitate more inflation? Taking a look at a fund manager survey from Bank of America here. If we could pull that chart up behind me right now, we're taking a look at some CapEx for the big tech names. But this chart indicates that these fund managers surveyed by Bank of America are anticipating further inflation here to the tune of 26% of those investors seeing a global economic boom to come, meaning above trend growth and above trend inflation. Now, growth can be good sometimes, but it's a little bit tougher when you are in an environment where inflation expectations are already a challenge. The Fed, of course, has been fighting back against inflationary pressures, and we are continuing to see, again, that fund manager survey, if we have that growth being a challenge and question mark moving forward here. And this goes back to what Treasury Secretary Scott Bessent said on Fox Business about the desire to keep the 10-year yield low moving forward. Is that going to be at odds with any moves from bondholders, specifically pricing in further inflation expectations moving forward off the back of tariff policies, which could be viewed as inflationary? This also mirrors some data that we've seen coming out of the US, Europe, and Japan indicating global inflation expectations ticking up. Of course, something that we will continue to cover, guys.
Maddie, thanks so much. Excellent stuff there. Coming up, everyone, could tariffs mean higher prices for customers? Ford CEO Jim Farley, he thinks so. We're breaking down the automaker's results coming up.
Ford topping fourth quarter expectations, reporting its highest revenue year ever. Yet you are looking at the stock off just about 6% in early trading. The automaker issuing a muted full year forecast for 2025, some of the headwinds that it's facing, and also projecting growing losses for its EV unit. Joining us now, we have Tom Narayan. He's RBC Capital Markets Global Autos Analyst. Tom, it's good to see you. So certainly we are seeing the potential here, and Ford saying that it sees a sharp profit drop here amid some of the threats that we could potentially see down the line from tariffs, but more importantly, the EV landscape right now and how that's shaping up. What's your initial reaction to the numbers that we're getting?
Yeah, the Q4 numbers were good. We all expected that. We saw that out of GM. There was a big pull forward. I think they had demand that probably hit December from January post-election. But then the 25 guidance, as you called out, that was a bit muted, worse than what folks were expecting. There's a couple of reasons, though. Some of them are Ford specific. They had 2 plant launches, which incur some launch costs. Also, EVs are growing, which is a good thing. The problem is that they are unprofitable. So you have more EVs than losses. So that's impacting not only the regular Ford E business, but also the Pro business. Because they're selling more EVs there as well. I also think, if you look at the inventory data, dealer inventories in January were 103 days. These guys typically like to be at around 50 to 60 days. So they called out some sharp cuts in production or wholesales really in Q1. So a bit of a muted look there, because obviously if your dealer inventories are stuffed to the gills, there's a little bit of caution there. You may have to cut pricing. They did also include some price downs there. So that really hurts the guidance. So probably some conservatism there, but also some of these launch costs. They did not include tariff impacts, by the way, in their guidance. But on the call, we heard a lot about it.
Tom, what does that tell you?
It's interesting. Actually, there's another company today that reported results, Aptiv, a very key supplier, who also did not include the guidance. I've been speaking to a lot of investors on this topic, obviously. And it's interesting that people acknowledge that if they were to be protracted, it would be a huge problem for this industry. But they're always using the word if, not, when. So I think the expectations from investors is that this will not be a protracted period of tariffs. They may last a few weeks. This is what we heard from that. If that happened, Ford actually last night said they can handle a couple of weeks. They wouldn't have to have anything cross the borders for that period. So an interesting perspective that folks are not incorporating it in their base case, certainly. But some overall just general conservatism of the macro outlook, just not on tariffs.
Tom, it seems like Ford is very much recognizing that the consumers, especially in the U.S., are liking their large vehicles. They like their pickup trucks. They like the expeditions, and they spend some time talking about that. Is there kind of a miscalculation, though, for how much the consumer is able to buy in to those large vehicles, knowing the price tags that they're also kind of navigating through at this juncture?
Yeah, it's interesting for sure. But I actually would argue that I think they were initially they were pushing this EV push with the pickup truck, the Lightning, and the Mach-E, and these are kind of not like super large, but like larger. And now you've heard them talk last night about let's shift now towards EREV tech and smaller cars for EVs. And it seems like that's a later kind of decision for them. GM has been selling large IT SUVs and dominates that, right? So they had already gone that route. It's now Ford, noticing that, like, hey, large SUVs where Americans want ICEs there. The EVs, maybe they should be smaller. So I think they're right in that calculus. It's just, they're kind of pivoting there now. I think if you compare it to like a GM, I think GM had already kind of decided to go that route. Their EVs are small, right? You have the Equinox, which is low price. People really care about pricing when it comes to EVs. That's the key there. And then on the ICE front, people want large SUVs. This is true.
Tom, just lastly, while we have you here, as we're taking a look at the rest of the car landscape, who is best positioned? Which remains your top pick for the rest of the year?
Yeah, I mean, it kind of goes back to the old staples. You know, within a period of uncertainty, you want to look at what's defensive. We like Ferrari, we like General Motors, and you know, we do like Tesla long term, big picture. So we think you stick to the stuff that's working instead of maybe trying to be cute.
Tom, thanks so much for taking the time.
Sure.
Appreciate it. I mean, that's my entire wardrobe. Just stick to what works instead of trying to be cute. Thanks. All your markets action straight ahead. Stay tuned. You're watching the Morning Brief. We're taking a closer look at some trending tickers this morning. We've got Roblox, Hershey, and Tapestry all moving on earnings. We're covering them in 30 seconds each. Let's go. First up, Roblox. It's falling big after missing on daily active users in the fourth quarter. The video game developer reporting 85.3 million users versus Wall Street's estimate for 88.4 million. And fourth quarter bookings just falling shy of estimates at $1.36 billion versus the $1.37 billion that was estimated. Roblox has been growing at a fast clip, with shares up about 90% over the past 52 weeks. But its results, coupled with disappointing earnings from Electronic Arts, is fueling some concern about the health of the industry.
Plus, Hershey beating on fourth quarter earnings bolstered by higher prices. But the chocolate company is issuing a weaker than expected annual profit forecast pegged to higher cocoa prices. Now, the results following a similar story at snack maker Mondelez, which issued a weaker outlook on cocoa prices a day earlier. Now, cocoa futures up more than 90% over the past year.
And meanwhile, Tapestry is boosting its profit outlook for the year. It now sees adjusted earnings per share of $4.85 to $4.95 on the top end. That's up from the prior estimate of $4.50 to $4.55 in that range. The boost largely attributed to an 11% sales increase at Coach, its biggest brand. Tapestry says its outlook includes the expectation for an additional 10% tariff on goods imported from China into the U.S. The fashion firm says tariffs are not expected to have a big impact on fiscal 2025 results.
All right, well, that does it for Morning Brief. But join me and my co-host Madison Mills for the next hour. Much more analysis coming up on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we get the outlook for rates as Treasury Secretary Scott Bessent looks to push bond yields lower.
Plus, we dig into how the Trump administration's policies will impact the economy and the stock market.
And a look at how tariffs are impacting farmers, retailers, and Amazon among them, with the company set to report after the bell.
Treasury yields are rising today after the 10-year yield dropped below 4.5%, still below that level here this morning. We're right around 4.43 now. The move's coming on the heels of commentary that we got from Treasury Secretary Scott Bessent to Fox Business. Bessent saying that President Donald Trump is, quote, not calling for the Fed to lower rates. Rather, the administration is focusing on lowering the 10-year yield. For more is our very own Jennifer Schomburger. Hey, Jen.
Hey, Shauna. Yeah, seemingly the Treasury Secretary taking a bit of pressure off the Federal Reserve. Treasury Secretary Scott Bessent saying President Trump is not asking the Federal Reserve to lower short-term rates. Instead, he and the president are looking to bring down longer-term borrowing costs via the 10-year Treasury. In an interview with Fox Business on Wednesday, Bessent said, quote, President Trump is not calling for the Fed to lower rates. When asked whether the president wants lower rates, he and I are focused on the 10-year Treasury. Bessent underscored that when the Fed did a jumbo rate cut last September of 50 basis points, the yield on the 10-year Treasury actually went up. Bessent says the president believes if the administration rolls back regulations, makes the 2017 Trump tax cuts permanent, and gets energy prices down, then rates will, quote, take care of themselves. Now, Bessent repeated his economic plan, dubbed 3-3-3, which aims for getting the deficit down to 3% of GDP from above 6% now through cutting regulation, as well as sustaining growth of 3% and boosting oil production by 3 million barrels a day. The newly minted Treasury Secretary also noted he will only talk about what the Fed has already done, not what he thinks the central bank should do from now on. Bessent's comments come after President Trump said Sunday night that the Fed was right to keep interest rates unchanged at its policy meeting on January 29th. Trump's about-face also comes after he initially criticized the Fed's recent policy decision, arguing they, quote, failed to stop the problem they created on inflation. Now, Bessent also offered some assurances about Elon Musk and Doge's access to the Treasury's critical payment systems, telling Fox Business that, quote, our payment system is not being touched. We're conducting a study. And can we have more accountability, accuracy, and traceability of where the money goes? Guys?
All right, Jennifer, thank you so much. Shauna, what is really interesting about what we are hearing from Treasury Secretary Scott Bessent is that the idea of keeping the 10-year lower, you could argue, is at odds with some of the inflationary policies coming from the administration, like tariffs. This is something that, if we have that chart of the day, is something that fund managers surveyed at Bank of America are already pricing in as a potential risk for 2025. The idea that the bond market might have to price in further inflation off the back of these policies, but then he's saying he wants the 10-year lower.
Yeah, and when you take a look as to why the 10-year yield has been elevated now for quite some time, continues to be elevated. Yes, we are hovering right around the lowest levels that we've seen in just about a month, but still not far from that 4 or 5 level, and still not far, obviously, from where we had seen a recent peak within the 10-year yield. And a lot of that has to do with some of that uncertainty surrounding inflation, surrounding pricing pressures. Obviously, tariffs potentially could exacerbate some of those issues and put even further pressure to the upside there in yields going forward. So when you take that into account and also square that with some of the commentary and rhetoric coming from Bessent when it comes to his energy policy and what he wants to see there. And I think what stuck out to me is very much how much of that is more so sentiment driven versus how much of a material impact that is going to have, just given where production levels are right now with energy and how willing we are going to see some of these oil giants be in boosting their production. That's something that's very much been debated on the street right now. But he has made the argument that when it comes to lower prices, when it comes to a lower deficit, that obviously could be more of an improvement and could ultimately lower yields. You just got to question with the tariff policies coming out from the White House, with core PCE at right around averaging 2.8% now for quite some time. Not too far from that 3% threshold that we've heard from a number of economists here on the program that could potentially make the Fed maybe rethink its policy going forward. Could obviously add to more of that inflationary picture there down the line. So again, it very much, you could see the initial reaction in the market yesterday and obviously here this morning. But again, further digesting that news, you have to ask just how feasible it is to do that.
Especially to your point this morning when we were talking about this, Shauna, the idea that energy prices are already low. So lowering the cost of energy further, while that is a key driver of consumer sentiment, that might already be as baked in as it can be. If gas prices go even lower than they're at now, I think consumers might say, okay, I want my grocery prices lower, which is something else that Trump promised on the campaign trail.
All right, well, President Trump set to meet with GOP lawmakers on the budget resolution. This coming after Senate Republicans split from the House over plans to hold off on tax cuts until a budget reconciliation package is sorted. For more, we bring in Jonathan Davidson, the former chief of staff at the Department of Homeland Security, also former assistant secretary of the Treasury for Legislative Affairs under President Biden. It's great to have you. So help us sort through some of the headlines coming out from the White House. Obviously, there's discord even within the Republican Party. That when you look broadly speaking, obviously a lot of pushback when it comes to the left. How do you see this escalating, and I guess the next couple of weeks playing out in regards to this?
Thank you. It's nice to be with you, and it is hard to keep one's eye on the ball in this environment. But I think you're right to focus on the reconciliation packages and some of the discord there. I think we'll see some more later this morning. The House Republicans are meeting with the president in the White House to go over their version of what they envision to be a reconciliation package in the long run here. Their preference has been stated as a singular bill that would include the tax cuts and everything else. The Senate Republicans have described their ambition to their interest in doing a shorter term, smaller package, breaking that off of the bigger bill and then doing a larger tax package later in the year. So we'll see what comes of it all. But I think you can make the case that the Senate is trying to put pressure currently on the House to kind of get its act together to move forward here, because they've had a lot of internal debate within their House caucus to try to resolve and move forward.
And Treasury Secretary Scott Bessent saying he wants those tax cuts from President Trump's first time in office to become permanent. How difficult is that going to be from a legislative perspective, in your view?
It's extremely difficult, and as you know, I think the reason the tax cuts are not permanent from the TCJA in the last go round in 2017 is because they went through reconciliation to enact those tax cuts, and now there's a question of whether they're going to do that again. That doesn't allow for permanency unless you pay for it entirely outside the budget window, and so it's a real challenge. I think that if they do want to go that direction, it's probably going to require a bipartisan approach, and whether or not that's a reality is still very difficult to foresee at this moment, because I think they're very focused on a reconciliation approach at the current time.
Jonathan, what would the bipartisan approach or potential outcome look like?
Very, very good question. I mean, there have been some areas of tax policy where there's been some overlay. You've got some geography that defines tax policy and SALT, but the reality of that is pretty hard to envision at this moment. I think there's just so much more focus and emphasis on the reconciliation process currently. And I think with all of the kind of chaos that you're seeing through executive action, it's hard to see a negotiation breaking out at the moment. I do think that, if Treasury Secretary Bessent really wants to get what he suggests would be the most important thing for the markets for stability, maybe there could be some quiet discussions going on to see what behind the scenes could be accomplished for a permanent tax deal. I think the corporate rate is going to be, a very hard sell to anybody on the Democratic side at this point.
Mm-hmm. And Jonathan, I want to switch gears a bit because you were former chief of staff at the Department of Homeland Security. So we want to talk both immigration with you and also some national security challenges. Starting there, I spent some time at the department last fall, and it was very clear to me how focused folks are at the Department of Homeland Security on the fentanyl challenges. Given your experience with DHS, how effective do you think tariffs are as a tool to fight the challenges related to fentanyl coming into the U.S.?
It's a really good question. I think it's a powerful tool for a lot of reasons, for a lot of purposes. I don't think that the current interaction and engagement between Canada and Mexico in terms of the threatened tariffs, the kind of 30-day pause that we're in now, and the subsequent National Guard posting at the border on either side of the border is necessarily going to have a dramatic impact on fentanyl. Fentanyl is not as much of a threat from the northern border as it is from the south. Mexico, has needs technology. There is in the Senate effort that was announced yesterday. There's an effort to try to put more resources to the border. Those are really the kind of the technology that we need, the additional personnel. Those are the things that make a significant difference on our side of the border. I don't believe that the concessions that were gained in this last go round of the threatened tariffs were significant for that fight. It does catch people's attention, and it makes people at least engage in a conversation. I think similarly with China, you can see a scenario where China would do something around precursors related to fentanyl in the face of threatened tariffs. But it's a tool. It's a blunt instrument, and what it actually yields often is really in the eye of those who are being threatened with the tariff.
Jonathan, I'm curious, as we take a step back and take a look at what has happened since the Trump administration took effect the second time around, and the cost cutting being led by Elon Musk and the defunding and the plans to do so, what has already transpired over the last several days. Obviously, now there's fears that more and more workers are going to be laid off or offered some sort of severance packages. What's the biggest risk in your view from being inside DC there that this potentially poses, not only from a national security standpoint, but also just from an economic standpoint, from a market standpoint that investors need to know?
It's an important question. I think that there are significant risks that when you combine all of these things together, look, I think that this new administration is filled with capable, smart people. There is chaos, and I'm not a person who believes in caricatures. I do think that the question of where in the chaos is the plan, and what is the kind of, how does this respond to the mandate of lowering prices, and addressing the migration problem. The real risk here is that, you just take USAID as an example. It's a little known agency by most in the American public. It's a $40 billion budget, but it's doing significant work to try to counter what China is doing in various parts of the world, and it has a significant role to play in terms of supply chains and how we engage in diplomacy in those parts of the world. And so, you take that loss of brain trust and loss of expertise and that loss of a tool, and you combine it with some of the other threats that are being made through tariffs. You look at some of the other impact here, and at some point the world, the rest of the world is a strategic set of countries that are looking to make alliances and looking to make sure that they can pressure back, and whether or not we get out over our skis too much and we kind of leave opportunity on the cutting room floor because we've kind of overreached is really my biggest concern. I think there's again, every new administration comes in and out of the gate, executive actions these days are a big tool and something that, makes a lot of noise. The question really is, what is the actuality of the legislative initiatives that are taken, and what is the long term through the courts? What impact do these actual policies have on personnel? We'll see how many people take the buyout. It's hard to see right now whether that survives a court challenge, which is underway. But it's really the overreach that I worry about.
All right, Jonathan, we got to leave it there. Thanks so much for joining us. Appreciate it.
Thank you.
The stock market surged following President Trump's win, in part due to the expectation of tax cuts. But with that looking to be potentially delayed, could investor enthusiasm for this administration fade alongside it? For more, we've got Brett Nelson, the head of tactical asset allocation at Goldman Sachs Investment Strategy Group. Brett, thanks for being here. If we don't get tax cuts, how rough could that be for the market?
Well, I think that there is a spectrum of policy pejoratives of the new administration. And so on the one hand, we have things that are very market friendly, like, as you mentioned, tax cuts and deregulation. On the other side, we have some of the things that you were just speaking with Jonathan regarding immigration policies and what we do with tariffs. And so it's really a question of, how far that dial is turned in either direction. I think it's likely that there will be a focus on tax cuts and deregulation. It's a cornerstone of the Trump administration's policies. And so I think it would be quite surprising if nothing happened on that regard, especially just an extension. Whether we get additional tax cuts, that's a whole separate question, in terms of the corporate tax rate. But it seems likely that they are going to try to extend the tax cuts that were put in place in 2017 along kind of the lines of what the market is currently expecting.
But when it comes to how much optimism has been priced in, when it comes to just the overall degree, even beyond the tax cuts, your read just about how maybe caught off guard the market seemed to be when it comes to tariff, and maybe what that spells just about the downside risk then that lies ahead.
Yeah, so I think that, we expected there to be volatility related to tariffs this year, and certainly they have not disappointed in that regard. But when you step back and look at even the language that was in the White House's fact sheet, they used the word leverage 6 times, they used the word tool twice. And I think if we look at what's happened in the last week with Colombia, Mexico, and Canada, it seems like these are tools to extract some type of concession from our trading partners, as opposed to an end in of themselves. I think there was a lot of concern initially that these would be things that would be an end in of themselves to raise revenue and things like that. And it seems like they are more of a negotiating tool to get things that are important to the United States and our interests. Now, our view is when we step back from the tariffs and a lot of the volatility, at the end of the day, we think 2 themes that we've had for 15 years or so in the investment strategy group, U.S. preeminence and stay invested, are very much intact. And the reason U.S. preeminence in particular, we think, can weather the set of challenges that we're seeing is because these are things that are structural. They're not likely to change overnight. And what I mean by that is if you think about the U.S., for example, it is the largest country in the world. It is the wealthiest developed economy in the world, and it has the largest and deepest financial markets. It's the only country in the world that has all 3 of those characteristics and is in the top 10 of each of those. And that means the U.S. has a tremendous advantage in terms of how much it can invest in healthcare, R&D, innovation, the military, education, et cetera. These are things that are not going to change overnight, and they have persisted throughout many administrations in the past, rather than because of those administrations. And so we again focus on that because that really underpins our staying invested in U.S. assets. We have an 8% total return target on the S&P 500 this year. We think corporate earnings are going to grow around 10%. These are things that are likely to persist regardless of the headline noise we get around tariffs in our view.
8% sounds low to me, and I know I've been, spoiled by 2 years in a row of double-digit returns here, Brett. How do you think about your narrative of U.S. dominance staying intact and your bullishness on that with the fact that you've got a price target on the S&P that doesn't necessarily mean huge gains that I've come accustomed to?
Yeah, so it's a fair point that I think as investors, we know that there's probably some quantum of returns that the market has to offer relative to its fundamentals. And so clearly we've come through an environment in the last 2 years where we've had 20% plus returns. in the last 2 years, that is obviously atypical. So I think it's very fair to say that it's unlikely we can sustain that level of appreciation. And one of the things we highlight in the report is that from the trough of the financial crisis in 2009, U.S. equities have delivered 17% annualized gains. That's obviously well above the historical average. So first and foremost, yes, you are correct. It's unlikely we can sustain those returns. But when you think about 8% in the context, you have to ask, well, how does that compare to my alternatives? And when we look at cash or bonds, we think those are around 4 to 5% returns. We're placing low 20% odds on a recession. Recession's the greatest risk to equity investors because that's where 3/4 of bear markets have come from. So if you have low recession odds, then you worry less about the defensive characteristics of cash and bonds. And then when we look at other equity markets around the world, we think that those returns are probably 6 to 7% versus 8 in the US. And if you're a US dollar-based investor, you're going to have to weather the fact that we expect the dollar to appreciate a few percent, which would drag on those returns. So on a relative basis, it is the kind of the tallest tree in the forest, so to speak, from our perspective, even though it will not deliver the type of returns that we've seen in recent years, to your point.
Guess you got to be thankful for what you could potentially get, and making that sound, I guess putting in context, 8% doesn't sound that bad. All right, Brett Nelson, great stuff. Thanks so much.
Great, thank you.
Coming up, we're going to take a look at some of today's trending tickers, why one chip maker is on track for its worst day in years. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session, all done with Yahoo Finance's trending tickers page. First up, Apple. It's a supplier here, Skyworks, under pressure today after Skyworks forecasted a decline in revenue for the current quarter. The company expecting a hit from growing competition in the smartphone market. Now the chipmaker also naming former Intel executive Philip Brace as its next CEO, announcing a $2 billion stock buyback. So certainly a lot to unpack within this report, but you're looking at Skyworks shares off just about 23%. So they are off the lows of the morning if we're looking for some sort of silver lining within some of that selling action that we are seeing this morning. But just to put this in perspective for you, Apple is Skyworks' largest customer right now, and they expect share of that business in regards to their components to fall by 1/5 all the way up to a quarter. Clearly, that will have a detrimental and a massive impact on their bottom line. We're seeing that reflected in the selling pressure here this morning, and that is why, to the degree that we are seeing shares down just about 23%, Maddie.
Yeah, it's that's interesting because they talked about how the iPhone represents 85% of their overall revenue just from Apple, one of their largest customers, as you mentioned here. And that's interesting when you contrast this with Qualcomm, because Skyworks had talked about kind of the competitive landscape being too intense. They didn't say that there's too much pressure on iPhone sales itself leading to this. They talked about competition in the smartphone chip space. And then you take a look at a company like Qualcomm, that stock dipping after earnings, but a bright spot in their earnings was smartphone chip revenue coming in hot for the third quarter in a row, up 13% on the year. So one of the questions here is, are companies like Apple looking elsewhere and potentially no longer going to be the biggest customer for a company like Skyworks? And what does that mean for investors moving forward here, especially given that there is, of course, the geopolitical concerns as well regarding tariffs and things of that nature, export controls that could also continue to weigh on some of these chip names moving forward. All right, next up, Roblox missing estimates for fourth quarter bookings and daily active users. The gaming company also issuing a weaker than expected forecast for bookings this year, and the outlook adding to concerns about the health of the video game industry. This follows a disappointing outlook from Electronic Arts. I should mention some of the biggest drops in Roblox that we've seen in years. The stock down 15%. It was at a record high right before earnings, so I think that's important context for the degree of this sell-off here. But really, that annual bookings coming in below estimates, sparking a bigger fear about growth at Roblox slowing after years of strong progress here that they have had. That could be one of the potential reasons that we're seeing this. And then, of course, one of the biggest issues was that daily active user count still coming in high. I believe it was a 19% gain in that daily active user number, but that just wasn't as high as the street was looking for. And then, of course, the guidance disappointment there as well.
Exactly. And this company has very much been in focus in the spotlight ever since Hindenburg Research, a report claiming about inflated user growth, child safety issues. Much of the decline that maybe we did see in the fourth quarter largely being attributed to the fact that they are cleaning up some of those inactive customers, some of the bots on the platform. Going forward, there'll be with so much focus on that growth, Maddie, that you were just talking about. Well, what was interesting to me was some of the analyst commentary surrounding that. And they said that maybe this reaction, the degree to which we're seeing some of that selling this morning, is overblown, because when you take a look at these numbers, it is the third consecutive year of roughly 20% growth in bookings. So even as many of its rivals here are trying to do all they can to win back some of their lost customers, especially in the face of slowing macro environment, inflationary pressures, are still getting a growth rate that is relatively impressive, especially when you compare it to some of the other competitors right now on the street. So I thought, putting in perspective, especially Wedbush's Michael Pachter, who has been on the program with us a number of times, he was saying that there is still a lot to be encouraged about within this report once you do look at some of those underlying numbers there. So I thought that was interesting, just in terms of whether or not maybe the initial reaction, the setup that we're going to see going forward, investors may be using this as an opportunity to buy.
And that's in part why I wondered if some of the selling was just due to the run-up that we'd seen in the stock heading into earnings, because yes, their guidance came in kind of near the lower end of estimates, but it was still above estimates there. So if you look at some of those kind of under the hood data points, it was still a positive print.
All right, let's take a look at Maersk reporting better than expected fourth quarter results, boosted by disruptions in the Red Sea. Now, the shipping giant expecting 4% global growth this year. That was despite uncertainties surrounding the Trump administration's trade policies. You're looking at gains of just about 1.5%. Have been up about 6%, I believe, just over 6% in earlier trading there. They also had a buyback announcement there that was adding to some of that risk on sentiment earlier. But again, when you take into account some of the uncertainties that still are present, or still are very much present for Maersk, when you talk about the global macro picture right now, the trade uncertainties, geopolitical conflict, how that then could potentially weigh on a name like Maersk, very much is one of the topics that is in consideration here for investors, for their CEO, as the executive team tries to navigate this very uncertain time. Yeah, especially when you think about the reopening of the Red Sea that is expected by mid-year, according to Maersk, which they talked about in this earnings print here. That could potentially weigh on freight rates, which have been more expensive in that region due to some of the blockages due to Houthi attacks in the Red Sea.
see if we see that geopolitical risk getting off the table, what does that mean for their profit margins moving forward if that is no longer a factor in those increased profits for them. Having said that, there, as you mentioned, Shauna, 4% growth in the container market overall this year, fourth quarter earnings beating estimates with that revenue coming in, rising 24% and seeing that 2025 EBITDA from $6 to $9 billion, squarely above the estimate there at the higher end because the estimate was $6.7 billion. So those fourth quarter earnings and that revenue really coming in strong. And then you've got the buyback cherry on top of all of that as well. So it'll certainly be interesting to see whether or not those company fundamentals can outweigh some of those broader policy risks with regards to tariffs and then, of course, globally with geopolitical risks this year as well. All right, coming up with the intensifying trade war in China, Chinese retailers hit with an additional levy, what that could mean for some of your online orders. Plus, we've got the CEO of Brooks Running explaining how the company could navigate tariffs moving forward. Stick around for those conversations next.
Chinese retailers that sell products on Shein and Temu will now have to pay an additional 30% levy on goods shipped to the U.S. This after President Trump imposed a 10% tariff on goods from China and revoked a de minimis exemption that allowed small packages under $800 to enter the U.S. duty-free. Joining us now is Arun Sundaram. He is a CFRA's senior equity research analyst. It's great to have you here. Let's talk about the impact that this has overall on retailers. Who is the winner in this situation? Is it a name like Amazon?
Yeah, no, I think all the large discretionary retailers in the U.S. are winners from this. So Amazon, Walmart, Target, I think these will be winners from this because, one thing we've learned, and even some of the e-commerce retailers, like I think Etsy would be a winner from this. eBay might be a winner from this. Because I think one thing we learned over the last few years is that these Chinese competitors, Temu and Shein, have gotten really competitive in the U.S. and taken away some market share. We even saw Amazon last year. They introduced their own similar model to Temu and Shein called Amazon Haul, and that was really a competitive response against these Chinese retailers. So, I think at the end of the day, it's a net positive for these large U.S.-based retailers.
That's interesting, Arun, and it's great to chat with you here. I pulled a stat this morning, 25% of the cost of products for Amazon come from China, and of those products, about half of their products sold overall are coming from China on Amazon. So obviously a huge potential impact. But are you saying that the kind of risks on tariffs to a Shein and Temu outweigh the risks that could cause to a company like Amazon?
Yeah, and I think Amazon has a lot of optionality. One, it's because they have both their own first-party e-commerce business and they have a very large third-party e-commerce business. In fact, their third-party e-commerce business has gotten larger than their first-party business as they introduce more third-party sellers. But yeah, you're right. No, Amazon doesn't disclose how many third-party sellers they have coming specifically from China, but there's indications that it's a large percentage. But again, Amazon does have optionality. I think we could see some third-party sellers leave. We can see other new third-party sellers enter Amazon. This does open the doors up for more US-based third-party sellers. But again, yeah, I think the thing about Amazon is that they have optionality. They have a very broad selection of products. They have a large third-party base. They have low prices. They have fast shipping, and at the end of the day, I think they'll be just fine.
Arun, let's talk Amazon's results after the bell tonight. Very high expectations. They're expected to have a strong quarter when it comes to retail. Some of the trends that they saw during the holiday season is expected to boost results. Also, the cloud business expected to very much outperform. What does this setup look like for Amazon overall this year?
Yeah, I think for this quarter, for Q4, I think the setup is positive for Amazon. Their e-commerce business should have done really well, given that all indications were that we had a strong holiday season, especially for e-commerce retailers. So I'm not worried about the e-commerce side of Amazon. I think that we'll see a beat there. I'm also not worried about the bottom line either. Operating profits, that's been an area of positive surprise for Amazon over the last few quarters. In fact, the last 3 quarters, Amazon has been on the operating profit line by an average of $2.6 billion. So I'm not worried about e-commerce. I'm not worried about the bottom line. Where investors tend to focus more on is AWS and their cloud business. And the bogey for this quarter, for Q4, is 19% AWS growth. And if they hit that 19% AWS growth, that would represent stable growth from Q3 and Q2 of 2024. And I think that would be viewed as a positive because we did see some misses in the cloud business for Microsoft and Google. Both of them saw a deceleration in cloud growth. So if Amazon can hit that 19% mark, I think that would be viewed very favorably by investors. If they hit 20% AWS growth, then we're going to start having questions about whether Amazon's taking market share away from companies like Microsoft and Google.
Yeah, Arun, talk to me about the CapEx question mark, because this has been such a sticking point for Wall Street this earnings cycle, with that $75 billion in CapEx at Alphabet, leading to a sell-off in the stock following their earnings. I know you forecast about $86 billion in net CapEx for Amazon in 2025. Is that number going to be too high for some investors?
So I think the risk, there's probably upside risk to that estimate now. What we've learned over the last week or two with all these big tech earnings is that CapEx numbers are rising more than expected. So yeah, we're forecasting about $86 billion in 2025. My guess is when they report today, they don't always give exact guidance for CapEx, but my guess now is probably going to be above $90 billion in CapEx. I think one thing we've learned over the last week or two with all this DeepSeek news is that these big tech retailers or big tech companies are not backing down. In fact, this has essentially lit a fire underneath them, and they're actually trying to become more competitive now and raise their CapEx expectations. So yeah, I think that could be a risk where if CapEx is higher than consensus, especially, then it could lead to a sell-off like we saw with some like a Microsoft and Google.
All right, Arun, we got to leave it there. Thank you so much. Appreciate it.
Thanks.
Brooks Running ended 2024 with record revenue, reporting a 9% jump from a year ago. The brand growing over 200% in China in the past year. But could proposed tariffs and trade tensions between the U.S. and China put pressure on the brand? Dan Sheridan, Brooks Running CEO, joining us now with more. Dan, it's great to have you. Thank you for making time with us this morning. I mean, you have bucked the trend when it comes to sales in China, as we just mentioned in our intro here. How are you thinking about strategizing against any potential headwinds to that success that could come in the form of tariffs?
Good morning, Maddie. Thanks for having me. Yeah, I mean, it's a complicated puzzle, right? I think what we root in first and foremost is population of runners. And what we're seeing in China is just incredible. As the middle class has grown, more people are investing in health and wellness. And that's benefiting us. In our 2024 results, you're seeing the results there, and it's happening across the market. Whenever you enter a market, and we've been in that market now for 3 or 4 years, there's risk, and we know that. But the fundamentals of participation and run is what drives our business, and those are very, very strong. So we're going to continue to invest in China.
Yeah, Dan, it's good to see you. The last time we spoke was out at Berkshire's annual shareholder investor day, and we talked about the opportunity in China, the opportunity in Europe, and I bring up Europe too just because of that trade conversation, the tariff conversation. Why is it not making you maybe rethink that? And I guess when it comes to the higher cost, is that something that you're going to swallow, or is it something that you then pass along to the consumer?
Yeah, I think, it's a bit of both. When you have shocks in your supply chain, whether that's through transportation networks or your manufacturing network, you're always looking at the markets. And what we've been able to do is create incredible products that are received by these markets. So we have a bit of a pricing power. And our consumers are incredibly strong right now. Retailers are strong as well. So we're not seeing as much pressure on average selling price right now. Tariffs may change that. For Brooks, we're a global brand, global trade, super important to us. So, we're creating redundancy, responsiveness, and agility through our supply chain. And we've been able to do that really well over the last 4 years.
So just to put a bow on it, will you pass on any potential cost increases to consumers?
Well, here's where we sit right now. Due to where we have our shoes manufactured, we really don't have an impact on from the tariffs coming. We're out of China. We're mostly in Vietnam. And so, as we sit right now, we don't have that pressure on us. Is it coming? We don't know. That's the uncertainty that everybody's dealing with. If they came, we would probably have to consider raising prices at the customer level.
Dan, when it comes to the areas, the regions here in the U.S. that you are seeing the most strength, does it vary at all from region? I guess, what does that tell you?
Yeah. So in 2024, we saw growth in every single region and every single channel. We hit record growth for us around the world. The majority of our business is here in the U.S., but our opportunity is expansion throughout the world. We've got a great business in Europe. We grew our German market 2 times the market last year, and our France business grew 3 times the market. So we're seeing running around the world grow, and Brooks is right in the middle of that, which is the results that we released today.
And zooming out a little bit, one of your investors, obviously Berkshire Hathaway, and I'm curious, Dan, what are your conversations with folks at Berkshire, perhaps Warren Buffett included in those conversations? What do those conversations look like? What guidance have they given, and what have they been asking you about the path forward for the business, especially under this new administration?
Yeah, I mean, we're super fortunate. We've got maybe the best owner in the world supporting Brooks and all the initiatives we have. Here's what Warren says to us every time we talk to him: focus on the customer and invest in your brand. Make sure your brand's stronger at the end of the year than it was at the beginning of the year. And I think those are just sage advice for us as we navigate the uncertainty of tariffs and trade wars and the like. And so we have a maniacal focus on the runner, and that's benefited us really well in the products we bring to market, in the customers we're dealing with. And we try and stay focused on the most important things and not worry about the things that we can't control.
Dan, the rise in the popularity of Hoka, the rise in the popularity of New Balance over the last couple of years, how much tougher does that make the landscape for you?
We always have competitors. This is the most competitive category in sporting goods, and we're leading it. We lead it here in the U.S., and we're beginning to lead it in some of our emerging markets. So we've always had competition here. And what I'm excited about is I think this is a 10-year, maybe 20-year run for the business of running, because we have more investment coming from brands. The consumer is really healthy and investing in their health and wellness around the world, and that's going to benefit Brooks as the pie grows. So we pay attention to our consumer, but we're maniacally focused on the runner and active people, and that's benefited us really well over the years.
All right, Dan, got to leave it there. Thank you so much for joining us. Appreciate it.
Thanks for having me.
Coming up, we're talking to a 4th-generation farmer and head of the National Black Farmers Association about how tariffs could potentially affect prices both for farmers and consumers. That conversation next.
President Trump's proposed 25% tariffs on Mexico and Canada, initially set to take effect this week, they were delayed 30 days. But the ongoing threat of tariffs is weighing on farmers. And our next guest saying that the administration's proposals could be potentially devastating for the industry, especially amongst small farm owners. Joining us now, we want to bring on John Boyd Jr. He's the fourth-generation farmer and founder and president of the National Black Farmers Association. John, it's great to have you back here on Yahoo Finance. Walk us through just the threat that you see, the potential here from President Trump, the tariff threats that he has certainly announced, and what was very much feared earlier this week, the impact that that's going to have on your industry.
Well, and I'm a fourth-generation farmer, and if I live long enough to see a harvest this year, this would be my 82nd harvesting soybeans in this country. The proposed tariffs that the president is speaking about will have a devastating effect on America's soybean producers, such as myself. The last time President Trump imposed tariffs on China during his first presidency, the price of soybeans went from when he announced it, $16.80 a bushel, and all the way down to about $6 a bushel. And he had to create a marketing facilitation program to offset some of the losses for America's farmers. We had to wait for that. So those type of scenarios could really be devastating for America's soybean producers, many who have a very thin profit and margin, profit and loss there, and there's no room for error. The actual thought of tariff in this country scares a lot of people. So farmers need to know exactly what the president is going to do as far as tariffs in this country, and it's going to have in my opinion, a devastating effect on America's farmers and consumers, because if you can't get goods and services in and out of this country, as far as it goes for food, there's going to be higher prices for America's consumers and local grocery stores around this country.
Yeah, John, thank you for explaining that. And I wonder if you can kind of operationalize for me and for our audience of listeners who may not be familiar with the ins and outs of farming in the United States, how these tariffs impact prices. Like, what does that read through like? And then what does a farmer have at their disposal in terms of tools for fighting back against these tariffs? Like, what kind of supply chain changes could farmers potentially be looking at to get around the worst of the financial impact of these tariffs?
And thank you so very, very much, because that's a very, very important question. Farmers are, like myself, either have storage facilities on their farm or they're cash and carry. I'm a cash and carry producer, which means I sell to local grain elevators. When those, last time the president imposed tariffs, those elevators stopped purchasing soybeans from America's farmers. So during harvest, you have to be able to harvest, get your crop in your combine and into your storage facilities. If not, you have to take them directly to a grain elevator for market price. When those elevators get full, all of those big tanks, and China stopped purchasing those soybeans, and that's what happened, the grain elevators are now full. So there's nowhere to take the soybeans to, and that makes the price plummet. And for those who don't understand, economics is price on demand. So there was no demand for it, and the price bottomed out. And China started looking to other countries such as Brazil to get soybeans and things of that nature. But when you can't get the products in and out again because of tariffs, those costs are passed on to the American consumer. I don't care how you break it down. And when you walk into your local grocery stores, you start paying more for fruits and vegetables and all of these things. So the tariffs, I hear what the president says, he wants to use them as a bargaining tool, but the ultimate factor and the first person in line that it affects are America's farmers.
John, given the fact that we could see potentially universal tariffs, a blanket tariff, does that then make the situation even worse for farmers and the ultimate impact that it's going to have on price, that we'll see prices spike even more so than we did see during the first administration?
I would believe so, and thank you for that question. Because this time, as you know, the president put a 30-day hold on Mexico Mexico, for people to understand, is the #1 purchaser of U.S. grown corn. So we're still a couple of things that we still do pretty good in this country, and we produce corn, wheat, and soybeans just about better than anybody in the world. And it's one of the last few things that the United States dominates as far as excellence. So Mexico looks for that corn to make their products that they eat there in Mexico. So when you put those tariffs in place, and again, it affects the #1 person in front line are America's corn producers. So a lot of times you don't hear about this. You hear about the after effects, which is the higher prices in the supermarket because of all that's going back and forth with the tariffs. Mexico raises theirs, China's raises their tariffs, and we get caught into that game. But the first person in the chain that gets hurt are America's farmers, and that's so I'm so glad that you guys are doing this segment, and I'm able to try to share just a little bit of light on that. And farmers are struggling. If you look at our organization standpoint, we're less than 1% of the nation's farmers. We're losing land, and when we get caught in these type of political fights, the bottom line is we lose more farmers and we lose land ownership in this country. And some of the other things that the president is imposing, all of the cuts on eliminating DEI also is a devastating effect on the National Black Farmers Association.
Right. And John, we're actually going to ask you to stick around in our commercial break for a second because we want to talk to you a little bit more about that. But thank you for now. John Boyd Jr., founder of the National Black Farmers Association. Appreciate it. And coming up, we're going to have all of your markets action ahead, so stay tuned for that. You're watching Catalysts. Lawmakers plan to introduce a bill today that would ban DeepSeek's chatbot application from government-owned devices over security concerns that the app could provide user information to the Chinese government. That's according to reporting from the Wall Street Journal.
Now, the legislation is echoing a strategy that was similar to what Congress used to ban TikTok from government devices, which marked the beginning of the effort to block the company from operating in the U.S. We know DeepSeek really moved the market following the revelations of headlines just about how effective it could potentially be, maybe the risk that this then poses to some of the massive spending that has been going on from some of the larger tech giants here in the U.S. But ultimately, I think the takeaway has been it's good, though, for wider adoption, right, going forward. So we'll see how this all plays out. All right, coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour.
It's time for Yahoo Finance's Market Minute. Stocks mixed as investors look ahead to Amazon's earnings out after the close. Eli Lilly shares rising. The company beats Wall Street's expectations in its fourth quarter and issued an upbeat outlook as Lilly sees surging demand for its weight loss and diabetes drug. And sticking with the pharma space, Bristol Myers Squibb dipping today. The company saying generic competition for its older drugs will cause its full year 2025 revenue to fall more sharply than analysts forecasted. And Peloton shares soaring. That's after boosting its guidance and handily beating earnings estimates. The company striving for profitability after a shaky couple of years. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're examining your portfolio. We'll talk about ideas for artificial intelligence investing and how to broaden out beyond the Magnificent Seven. And real estate hacks. Mortgage rates have held between 6 and 7% for the last 2.5 years, according to Freddie Mac. I'll break this down with the Barbara Corcoran, who has 5 tips for your home search. Plus, the Super Bowl is nearly upon us. We'll discuss how to bet on the big game without breaking the bank. We've got all that and much more during today's show. But first, we take a look at some of the action here. We're 90 minutes into the trading day. Stocks, they are mixed as investors digest more earnings reports and look ahead to Amazon at the close today. They're going to be reporting earnings. Joining me now, we've got Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Brian, great to have you here with us in studio today. Thanks for making the trip.
Thank you.
You say that you're focusing on high quality factors when investing in stocks to help manage the recent volatility that we've seen play out. What factors should those be that investors are watching?
Well, we've come a long way with the Magnificent Seven in such a short period of time. Explosive growth, explosive revenues, all profitable. Those are good things, but we are where we are now. Mag 7 PE averaged 38. That's a very rich valuation. The S&P 500 now at 22 times the forward 1-year earnings. So where can we put money to work at a better valuation? So we're looking for those higher quality factors, which is strong cash flow management. So good free cash flow yield, low levels of debt, and low short interest. Those factors allow us to reach into some names that have a better valuation, but also the potential to maybe outperform that technology sector that's done so well over the last couple of years.
Nobody hears hedging in terms of an investment strategy and says, man, that sounds sexy, but that's really what's playing out right now as this volatility has certainly reared its head. So where are some of the top opportunities here and the ways to navigate volatility by hedging?
Absolutely, because sometimes boring is best, and that's what it comes down to. These are not super sexy names, to your point, but they do grow and they are very profitable names. And so what we like is companies that are using AI and analytics to be more targeted and more productive with the revenue that they're generating. A name that we really like is John Deere. Obviously, we just talked about farming. What you're seeing from John Deere is the ability to use AI analytics to build better, smarter equipment that is more efficient and effective for farmers to use. That means better, cheaper yields on the acreage, but also the ability to use less equipment and less manpower. That's productivity across the board. So John Deere is doing a great job of using AI, not just in designing their products, but also helping farmers be more productive as well. This is a great name, a PE of around 18, and a really strong revenue growth model for the next couple of years.
There's another pick that you had as well, I believe. It was JP Morgan.
JP Morgan, the biggest bank on the planet. Again, not a super sexy name, but they're using a growth model as well. And the analytics that they want to open around 500 branches in the next couple of years, it's really helping them target where to build those branches and what services they want to offer to engage with clients. Smart, efficient use of the capital that they're spending so that it will be more reliably profitable and productive for their balance sheet going forward, and a PE of around 13.
When you hear about some of the big CapEx dollars that are getting tossed around right now, the figures that are being brought up on earnings calls, how should investors be thinking about and evaluating when those spends actually turn into realized revenue and also pass through to the margins?
Absolutely. Looking into the details of what they're spending that money on, and then how is that going to be monetized. So if I'm building data centers to run large language models, what does that look like in terms of closing the loop and profitability? Is it just going to be a subscription service forever? Or does it turn into kind of like what Google has been for 10 years, and that is a free service for consumers, but supported by ads? We don't know that yet. It's a lot of money. We're approaching $1 trillion worth of spend on these types of AI projects over the last year, planned for the next couple of years. Where does that get monetized? How does that come back to the balance sheet? Google going to spend $75 billion. Where does that come from? At Microsoft, $80 billion. We want to see revenue coming back to the balance sheet and profitability.
I guess what also got exposed is what DeepSeek means, and more DeepSeek perhaps as the poster child for competition really means for some of the spends that have gotten put forward, but also what real competitive landscape within the AI applications also mean for the rest of the industry's investments as well?
Absolutely. And I think that if we carve out that large language model segment of AI, the competition is big and it's growing. You already have Gemini, ChatGPT, Grok, all of these names. Apple's going to come out with their own, and now DeepSeek jumps into the fray at a substantially lower operating cost. Does that mean that, like Google or search, that eventually this becomes a free service for consumers supported by ads? It's a bit of a race to the bottom right now. So monetizing large language models becomes a bit of a challenge with the wrench DeepSeek has thrown into that model. On the other side, generative AI, analytics, all of those have value that can substantially increase productivity, and that's the side that we're trying to lean into without the huge CapEx outlay. That's where we think we can find opportunity.
Who do you think has the most exposed business model as a result of potential free ChatGPT, DeepSeek-like tools, models, and applications that could be introduced to the market for free, as you were mentioning?
Well, I think at the moment, Microsoft is probably the one that has the most cloud business that they can support the large language model with. They've also been really good at Azure and it's stratifying different levels of service for enterprise use. That could easily translate into consumers in a free model, but enterprise functionality for businesses, again, the analytics side of it, that's one that I think would be very well positioned to do just that.
Brian, thanks so much for taking the time here with us. Great to see you.
Thank you.
Absolutely. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills here in studio. All right, let's hop on a stationary bike, if you will, for a hot second here. First up, Peloton. It's popping this morning after beating on profit expectations in the second quarter and lifting full year guidance for adjusted EBITDA to $300 to $350 million from $240 to $290 million here. Shares, wow, they're up by about 14% right now this morning, Maddie.
Yeah, a huge turnaround in place from the new CEO of the company here. It's interesting if you take a look at analyst recommendations for the stock, despite this huge beat today, still very tepid reaction on Wall Street, right? Over 80% of analysts have a hold rating on the stock right now, only 3 buys and then 1 very rare sell rating. Having said that, some bullish commentary following today's earnings print, right? Peloton's solid financials reflecting laser focus on efficiencies, also stronger than expected EBITDA here, and this is really important, a 26% guidance raise for full year with EBITDA of $325 million at the midpoint coming in hot there. Really great when it comes to the product mix. The new CEO, Peter Stern, really focusing on 2 things, efficiency and then mix with Tread and Tread Plus. It's not just about the bike anymore, it's also about those subscriptions, making sure that people don't cancel those subscriptions, keeping costs down when it comes to some of their staff. We obviously saw them cutting back on some of their A-listers over the past year, much to the chagrin of certain users, but all of those things clearly leading to a positive lift in their earnings.
Okay, the chagrin of certain users. All right.
Not to be named.
Okay, we won't name them. Not here, not now. You talk about some of the partnerships that they've had. They also had a partnership with Hilton, another company that reported earnings this morning. Hilton beating profit expectations in the fourth quarter, but falling short of a number of guidance metrics for the first quarter and full year. Shares, though, are up by about 5.6, just about 6% right now.
Yeah, revenue per available room is the kind of key stat when you are looking at earnings for hotels, and that was the shining star of this earnings print. Hilton's also going to be expanding into additional markets here, and just because of the bullishness around that revenue share per available room, we're also seeing a lift to other hotels in the space, Marriott and Hyatt, also trading higher today. When it comes to that revenue per room outlook for 2025, that growth leading the street to estimate that the company is going to potentially outperform their rivals, that they could also continue to expand more broadly in North America and Europe. And interesting to see that they are seeing that global expansion when we do have questions about what global economies are going to look like, especially as we get into some tariff conversations, and those policies could potentially be impacting companies globally as well. But one comment that stood out to me, strong trends in leisure occupancy and continued growth in the business continues to lead to expectations for favorable trends throughout 2025 here.
Yeah, 8% growth in their approved and kind of the development pipeline that they were mentioning here. 498,600 rooms in that pipeline. So we'll see how that ultimately gets brought to fruition and where we see some of the bookings be beneficiaries as a result. Stick around. We got one more here. And this one's a little tastier. Yum Brands. sales turning positive after 3 consecutive quarterly declines here. Same-store sales rising 1% in the fourth quarter, driven by growth at Taco Bell here. You're taking a look at shares up by about 8% on this news. Congrats to Sean Tresvant and the team at Taco Bell. He's the CEO over there and certainly contributed to Yum's results here.
I thought it was really interesting that they not only succeeded, as you mentioned, at Taco Bell, but they were also able to succeed at some other firms here. Obviously, strong Taco Bell sales fueling the beat here, but KFC, their same-store sales, they were flat for the quarter, but the fried chicken chain overall did see strong demand outside of the U.S., specifically in China, and that was actually a through line amongst all 3 companies that we just mentioned today, Yum, Hilton, and Peloton, all seeing a little bit of an uptick in demand coming from China, which could be a positive indicator just throughout our entire stock market because all 500 names have been impacted by that declining economy in China here. So if you can see growth there, that is potentially a positive catalyst for a lot of these names. Yum also growing its unit count by 5% over the course of this year. So we can continue to expect more of that growth. And then they had this AI announcement. They're giving franchisees some AI-driven software that can be used for digital orders for their kitchens. That could potentially make things easier for customer orders.
I thought you were about to tell me that AI was going to come up with the new taco that we're going to be ordering. If only, yeah.
But no, just like online chatbot stuff. Now that's just, even though AI is brand new, I'm like used to that by now. That's not as snazzy as it once was.
Exactly. It's the call center rejuvenated,
right,
I guess.
Exactly. Yeah.
Maddie, thanks so much for taking the time.
Thank you, Brad.
Appreciate it. Coming up, everyone, we're talking about the state of the housing market with Barbara Corcoran, who joins me on set. Stay tuned. Potential home buyers aren't having an easy time of it, with the 30-year fixed rate mortgage hovering between 6 and 7% for the last 2.5 years, according to Freddie Mac. This market has been plagued by high prices and low, albeit improving inventory. Here to discuss what to expect this year, we have Barbara Corcoran, founder of the Corcoran Group and a shark on ABC's Shark Tank, now in its 16th season.
Hard to believe, isn't it?
My goodness, congratulations on all the success.
They're going to bury me on the set in a few years.
You have a lot of time here. And speaking of time, we want to use some of this time to really help some of the potential home buyers out there. I want to talk about what you're seeing in the housing market right now and some of the tips that you have for buyers who are still trying to set some of these appointments and make the right decisions with their purchases.
Well, it's a little more difficult to find a house today because, especially in light of the lower interest rates, only by 1/10 of a point, big deal, right? Nobody's excited about that being lowered just a little tiny bit. But what's happening now is the sellers that have low interest rates are not putting the houses on the market, and they're not going to put the houses on the market, which means there are fewer homes to choose from. A typical buyer today doesn't get a big choice when it comes to buying a home. And on top of that, they're going to find that they're going to have overbids because there are just not enough houses to go around, and prices also will go up.
And so with that in mind and that kind of the lay of the land right now, what are your 5 tips for home buyers?
Well, I would say the most important overall tip is always look where somebody else is not looking, and that's always where you find your value. So right now, the 3 areas that, the 5 areas you wanted. 5, I made 5, okay?
3, 5.
Okay, whatever you'll take.
We like listicle numbers here.
Okay. You want to look at the houses that have been sitting on the market a while, not the houses that just come on the market where buyers tend to rush, everybody rushes to go see them. You're going to just do your search based on houses that have been on the market 9 months or longer. Those people are having second thoughts, thinking of taking a lower offer, ready to move, and that's where you want to put your low offer. You want to shop off season. People don't like to shop in the winter time or at Christmas time. They think it's a bad time. It's a great time to shop the houses because you're not going to have any competition out there, and they're going to be more likely to take your bid. You want to be also very open to a fixer-upper. Today, people don't want to bother with it because it takes upfront cash, but you can always get a construction loan. No problem getting construction loans today, and you can find a fixer-upper and add value yourself if you're willing to just wait a few months to do it. And then the other small tip, but it's an important tip, and I think a lot of people could take advantage of it, is you want to shop for houses with a second entrance. Why is the second entrance important? Because you can create a small unit in the basement or the back of the house where you can offset your insurance costs. So all these tips get you in the area that you want to be in, where you're not going to find other people shopping and competing with you.
Now, that last tip that you have as well here, and this one gets into my next question, which is what you're seeing in the thought process for potential buyers who are evaluating climate risks right now too.
Yeah, well, it's on everybody's mind right now. It could work for you or against you. First of all, when you're buying a house, you'd be crazy not to check out if you're in a high risk area, because right away you're going to increase your insurance costs probably by close to 20, some instances 25%, certainly in the LA market right now. The insurance is through the roof, and of course you understand why. But you want to size it up. But the good side of it is a lot of people are afraid of it. And so sometimes if you're not afraid and you want to take that risk, you can make a lower offer and get a house accepted. Get a house you like accepted.
Barbara, while we have you here, I want to turn to, of course, what we had started off some of the conversation with, or I acknowledged at the open, which is your Shark Tank brain, your VC mindset as well. Can you give entrepreneurs some tips for how to nail their pitch to get funding from venture capitalists?
Yeah, I think there are really only 3 things that have to be focused on, and very often people don't focus on when they're making a pitch. Not just on Shark Tank, but in the everyday world. You have to look the part. If you're a baker, you want to look like a baker. You want to leave your apron on. You don't want to look like an investment banker, and many people make that mistake. The second tip is when you go in there, you really want to practice. You want to over-prepare. There's no such thing as over-preparation. People think you over-prepare so you make a better pitch. You make a better pitch because it increases your confidence. That's what happens. And the last is that people making a pitch for their business never, ever answer the most important question on the investor's mind, which is, how am I going to make money on this deal? I will hear pitch after pitch on Shark Tank and on real life, and people don't even address it. That's all I care about. How am I going to make money? So you better answer that right between the eyes.
Are there extremely intriguing business types to you, even right now, to invest in? Because we know some of the VC dollars are being highly scrutinized, going out the door and investing in entrepreneurs, in startups, and in businesses right now.
I think the only important thing to think in mind is you you get off track evaluating the business and the numbers. I don't do that. I turn a blind eye, and that's a secondary stop. You really want to investigate, and you really want to evaluate and use your gut instinct on, do you trust the entrepreneur? Because in the end, the businesses that have failed miserably, or people that had second thoughts about the people, even though the business plan was rock solid. But when you really get a good entrepreneur, they're going to find a way to succeed. That's what they do. They succeed.
Barbara, thanks so much for taking the
My
time
pleasure.
here with us today.
I like your
Great
suit.
to see you in studio. Look, I'm trying to hang in the rare air with you, fashion icon, of course, and real estate mogul, plus VC, Barbara Corcoran.
Thank you very much.
Thank you. Coming up, everyone, we're talking about the biggest trends dominating AI investing beyond just chips. That's next. Shares of chipmakers Qualcomm, ARM, and Skyworks lowered today after disappointing investors with their latest results. And if you're looking for some new ways to invest in AI beyond chips, there's plenty of ways and insights in ARK Invest's Big Ideas 2025 research report. Joining me now to break down some of the biggest trends in the technology space and how investors can play them, we've got Brett Winton, who is the ARK Invest Chief Futurist. Brett, great to have you here with us. Let's start with AI here. What are the three names that you're watching within this space?
Sure. Well, there's platform as a service type companies such as Palantir that allow enterprises to set up their data to be successfully deployed against artificial intelligence. Of course, there's Tesla, which is using AI to drive its robotaxi service, which should commercialize by June. And then Tempest AI is a great example of deploying artificial intelligence into the healthcare space. And that really is the industry that probably has the most to gain from AI, since so many health dollars are inefficiently administered today, and AI can really drive better decisions and better patient outcomes.
Now, a lot of our viewers might be looking at the screen. They see Anthropic, they see SpaceX, and they say, hey, wait a minute, those are not publicly traded companies. Are we seeing abilities for retail investors or those who might not have the big dollars to throw around to get early exposure? And how is that kind of allowing them to focus in on the next wave of innovation to come through AI?
Yeah, we have the ARC Venture Fund, which is, we've really worked hard to allow that to be available to any investor, not just accredited investors who have to hit certain wealth thresholds. And so that has, OpenAI, Anthropic, XAI, SpaceX. These are all companies within that fund. And we really think it's both a unique investment exposure, and it's a great way to get access to innovation that you otherwise can't get access to.
Brett, as we think about AI, there was the major wrench that was thrown at the mindset of markets and investors with DeepSeek. And so with that in mind, is this a positive or net negative for AI development? How are you evaluating that?
Yeah, it just accelerates the performance improvement curve and the cost decline in AI. So artificial intelligence, we think, is cost halving every 4 to 5 months compared to traditional technology cycles where that takes 2 years. If anything, DeepSeek hit or potentially accelerated that curve. With every cost halving, we've seen an expansion in the amount of money invested and the number of opportunities that people see in deploying AI into real-world productive circumstances. The same is true here. DeepSeek is likely to drive and breadthen kind of the number of AI exposures that are interesting and just bring the future forward faster.
And as we think about, and you mentioned the halving of costs to make sure that AI is more affordable to operate, then there's also the halving that we thought about with crypto last year. I wonder how you are evaluating the cryptocurrency landscape and the calls that have emerged from ARC just around Bitcoin and where even stablecoins play into the larger landscape over the course of 2025.
Yeah, stablecoins are really important in growing innovation. It allows anybody in the world to get synthetic dollar exposure, and many emerging markets want synthetic dollar exposure. It should actually reduce the cost of funding, reduce interest rates in the US. And we think that stablecoins pair really well with Bitcoin, where people want kind of to use the dollar as a unit of account on a global basis. And they also want in a currency without a country, a hedge against everything that happens with the traditional dollar system. And so we think that you could end up in kind of a two-currency world in the future, where you have a dollar-dominated world with Bitcoin as kind of like this alternative currency that lives alongside it.
And so how does that also, crypto asset adjacent, when you think about the platforms that allow for the buying and selling, the trading and holding of crypto, does that thesis also translate over to the investment thesis for those platforms, thinking about Robinhoods, thinking about the Coinbases of the world?
Yeah, we think Coinbase is extraordinarily well positioned here. They facilitate, not just the trading of these instruments, but they are really building a robust layer 2 solution for smart contracting platforms to operate, and everything from prediction markets to meme coins to really new ways to deploy and motivate capital all accrue to Coinbase's benefit. And this isn't independent of AI. We think that kind of smart contracting ecosystems are where AI autonomous agents are going to really sharpen their teeth. And that could inspire a lot of activity as you have digitally native assets operated by AI agents into real-world capital markets. It could be a wild couple of years.
Brett, thanks so much for taking the time here with us today, breaking down some of these 2025 ideas. Appreciate it.
Thank you.
Vanguard is lowering investing costs from dozens of its mutual funds and ETFs. The firm says the reductions could save investors more than $350 million this year alone. To help explain and put it into some context here, we've got Yahoo Finance senior columnist Kerry Hannon. Kerry, what do we know about this?
Hey, Brad. Yeah, now this is the largest reduction in their fees in its entire history for Vanguard, so that's about 50 years. This is a big deal. It's 168 funds and ETFs where they've slashed their expense ratios, which is in essence the operating costs. So it's everything from management fees to accounting fees, legal fees, all kinds of things that go under the covers of what it costs to run these funds. That's what you think of as your expense ratio. And in fact, they slashed that 20%, which is really great for investors. And in fact, we may see more of their competitors doing a similar thing. So today, their average expense ratio at Vanguard is something like 0.07% compared to an industry average, which is around 0.44%. So this is really good news. Now, I've got to say, Vanguard is very low expense anyway. So they've already have very low expense ratios. So while it's significant when you say 20% cut, they're still pretty low to begin with. So it's the more important thing is the message it sends to people is that we care about your costs. Now, I'd be remiss not to mention that Vanguard in the last couple of weeks ago did have a settlement with the SEC for what is called for one of its target retirement funds. The settlement was around $106 million, and it was for quote, misleading statements related to capital gains distribution. So, there's always good and bad news along these things. So maybe it's back, a way of some good PR for them. But whatever it is, it's great news for investors.
So what do lower expense ratios mean for investors then? And how should they be thinking about this change in their portfolios?
Exactly. It all comes down to fees, Brad, because the fees are taken out of your investment return. So over time, even something that seems like minuscule, like I just said, 0.07%, right? Now that seems like a tiny little fraction of money. But when you look at it over time, it has an outsized impact on what your actual investment is going to return to you. So it's very important that people pay attention to fees because it's something none of us really think about. And you can go to the page of the mutual fund, you see, it says right there what the expense ratio is. Anything under 0.10% is considered low. Go for the lowest fees you can get. If you have the opportunity to find a low-cost fund, the lower, the better, because you'll be grateful down the road when you find out that there's less being taken from your account. If you want to know specifically what those quote operating expenses are, go to the fund's prospectus, which you can find a link to it on the fund page as well, and dig through all that stuff, and they'll explain what they're spending on. But the key is that fees matter. They matter big time, and a lot of people just think, oh, it's such a small amount. What do I care? You should care.
Carrie, thanks so much for breaking this down for us. A huge move, it sounds like, being made over there. Appreciate it. Coming up, everyone, the Super Bowl is this Sunday, and we're talking to a sports betting expert about the best ways to bet on the big game without breaking the bank. That's next on Wealth. sports betting around the Super Bowl is exploding in popularity as more states legalize the activity. Wagering amounts around the big sports day has nearly quadrupled since 2019, hitting $23.1 billion in 2024 and is forecasted to reach as high as $28 billion by 2025, according to Doc Sports. Joining me now, we've got Rafael Esparza, a handicapper at Doc Sports. Rafael, great to have you here with us today. So can you just start by breaking down what a handicapper does?
I want to jump back on that question. Just wait till Florida, Texas, and California have sports betting. We'll probably look at $35 to $40 billion. But what I am labeled as a handicapper / odds maker. I also do a lot of the prop bets that you can bet on throughout the Super Bowl. But a handicapper is what we like to call ourselves, is a guy that studies everything, that can give the public a better opinion on what's going to happen in the game. And we do the research for you so we can help the bettors out there to try to see what goes for over, under, who we like in the game, Chiefs, Eagles, or how many points are going to be scored. So it breaks it down like that. But for me, being an odds maker, I'm the guy that creates all those Taylor Swift prop bets, and Travis Kelce is going to get engaged after the Super Bowl. So it's pretty crazy right now.
So what trends are you expecting to see this year as wagering amounts grow even more?
It's been crazy. I'm here right now in Super Bowl week, and a lot of people wanted to bet the referee prop bet. So we get tons of action on referee prop bets of Kels. We have Travis and his girl Tay out there. People are betting that. But I think down the road, everyone wants to see, can the Chiefs do the three-peat? Right now, the Chiefs are -1. The books took a big action yesterday on the Eagles on that one, so that made the number come down to the Chiefs -1. A little bit shocking that a team going for a three-peat, only a -1 point favorite. Total is 49.5. I think the betting public will probably push it up to probably 50. So if you like the under, I would say wait for that half a century number to come out.
And so as a handicapper, what bets would you advise people to avoid this time around?
I usually tell people, just because there's a game on TV does not mean you need to bet that game on TV. But this one's the Super Bowl. Everyone's watching it. Have fun while I'm not saying you have to put down your double mortgage on it, but, put $10 on the coin toss. Maybe bet the commercial prop bets. Maybe bet, will Saquon Barkley run the ball and use his butt as a blocker? There's so many other ways to do that, but have fun on Super Bowl Sunday, because you're usually at a party. You're usually eating food you're probably not supposed to be eating. So Super Bowl, have fun. Don't bank all your money on just one bet.
Now, you also say to avoid non-football bets in particular here, and I will admit that I have fallen susceptible to this in the past, betting on the first song that Rihanna would perform a couple Super Bowls ago, which actually was the last time that these two teams met. So why should you avoid those non-football bets in particular?
I mean, because usually the odds are not that good. Usually the money, you can't bet more than probably $25 to $50 on those halftime bets. But it's just fun to have, and my wife loves to bet the halftime bets. I think the national anthem is probably getting more action than the halftime show itself. John Batiste is playing doing the national anthem, so you can bet over-unders on 1.20 seconds right now. I think the total is right now. And will he play the piano? -$4 is the yes right now.
So what tips do you have to make sure that people are betting responsibly and not blowing their budget, as you were mentioning and alluding to earlier?
Have fun. You're not going to make your mortgage payment on Super Bowl Sunday. Just have fun, bet small, bet with your friends, do the squares that everyone does. Just have fun on Super Bowl Sunday. You don't need to be stressing out on Super Bowl Sunday just because you have a $100 bet or a $50 bet. Have fun on Super Bowl Sunday. Eat what you're not supposed to eat.
Look, some of my friends would challenge that they're not going to make their mortgage back, and they would say, hold my beer on that one. But I wish everybody the best out there if they are going to participate. What are the best bet promos? Because that typically flies around as you see the customer acquisition costs really get factored in to the marketing that gets put out there from some of the sports book. Are there good best bet promos?
Oh, yeah. I mean, right now you can bet some books have even money on both sides to bet the game. So normally it's a 10% juice when you're betting either the Chiefs or Eagles, where some books have even money on both games. So there's no vig or juice, what we like to call it. And there's also, every book, you should always have multiple, as we call them, shops, but multiple books, because they give out such great bonuses. I know that there's going to be $1 million bonuses probably for Super Bowl Sunday. Take advantage of that. BetMGM has a great one. I worked for MGM for 13 Super Bowls. Caesars has a really good one. Both DraftKings and FanDuel have fantastic ones. I bet $5 to win $200 bonus. I do believe FanDuel is having right now. And you get the watch the kicking prop. Who Manning is going to kick a field goal? Is it going to be Eli or Peyton? Eli's a $2 favorite.
Wow. Okay, Rafael Esparza, a lot to keep tabs on here. I took a few notes. We're going to be watching closely here. We appreciate your time.
Thank you.
Thanks. And stay tuned for more sports betting talk with FanDuel CEO Amy Howe tomorrow at 9:45 a.m. Eastern Time. Among the wealthiest black Americans in the 19th and early 20th centuries, Junius George Groves received the name the Potato King of the World by the U.S. Department of Agriculture in 1902. A producer and shipper of potatoes on his farms, at the start of the 1900s, Groves had expanded his produce reach extensively throughout the United States, Mexico, and Canada. In 1910, black American farmers owned between 16 to 19 million acres of farmland, and today, that figure is less than 1% of the total, and the shrinkage is widely regarded as a contributor to the black-white wealth gap. Fast forward to now. The work of black farmers is again growing in recent years. According to the latest data from the U.S. Department of Agriculture published in 2024, the average size of black or African-American operated farms reached a record high of 163 acres in 2022. The National Black Farmers Association founder, John Boyd Jr., joined us on Yahoo Finance today and offered his outlook for opportunities in building wealth through farming.
Well, first of all, to build wealth, you need land. And we also need a more interest from younger African Americans to look at farming and agribusiness, to study at these major universities and farming and agribusiness, and to come out and start small. We're not looking for producers to be full-time, 3 commodity farmers like I am, but they can start on a much smaller scale, and we're going to need those farmers in the coming years to offset what's going on around the world.
Coming up, everyone, do you ever spend an extra few bucks just to get free shipping? Why spending money to save money, or spaving, can get in the way of your financial goals. That's next on Wealth. programming note on this week's episode of Stocks in Translation. DataTrek Research co-founder Nick Collas highlights the silver lining of DeepSeek's AI breakthrough and what it could mean for investors.
If there's cheap AI, and it looks like DeepSeek has shown us that that's possible, that's actually such a huge net positive for companies that are going to use a lot of AI, because that means that the $50 billion that they were going to put into it this year, just to pick a number,
Software companies.
just has to be maybe 10 billion. Where does the 40 go? Stock buybacks, dividends, things that enrich shareholders. So I'm not too worried about that feature. I think it shows that innovation can come from anywhere, but in terms of how you think about allocating money in a portfolio, you want to be in a space where profits are allowed and welcomed, and the government says it's okay to have private enterprise that makes people very, very rich. That exists in the US, it doesn't really exist in the rest of the world.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern on Yahoo Finance or wherever you get your podcasts. The suspension of the de minimis rule that limits the cost of shipping from China and Hong Kong means that e-commerce might get a lot more expensive. One silver lining, though, it might make more consumers realize they're spaving or spending more to save on fees like shipping. Yahoo Finance's Casey Bond is here to explain. So Casey, what exactly is spaving, and what are some of the common ways that people wind up falling into its trap?
Right. So spaving is essentially a marketing tactic that retailers use to get people to spend money in order to receive some sort of savings, or at least a perceived savings. Some common spaving tactics include buy one, get one, or BOGO, free shipping when you spend over a certain threshold, or similarly, a discount if you spend a certain amount. And while these might seem like a great deal, they often encourage us to spend money that maybe we hadn't planned to spend, or accumulate stuff that we maybe don't really need or even want that much.
And so, Casey, how can consumers separate good deals from spaving?
Yeah, it really comes down to having a solid plan for your money and spending intentionally. So that really starts with having a budget, so you know exactly how much you can spend in certain categories. Always making a list before you go shopping. If you happen to find a great deal on something on your list, great. Otherwise, avoid those spaving traps. And that also helps you avoid those impulse purchases that aren't really part of your spending plan and can cause you to accumulate more stuff that you don't really need.
Casey, thanks so much for breaking down all things spaving. You're going to make me think twice before I purchase online.
Thank you.
Thanks. Many college students are on a tight budget. According to a study last year, 78% of undergrads reported negative impacts to their mental health due to financial stress, and 59% considered dropping out over it. Joining me now, we've got Dan Mercado, who is the University of San Diego finance professor. Dan, thanks so much for taking the time with us today. I want to start with the top money mistakes that you see college students making. What are some of the most common issues?
Yeah, hi, Brad. Thanks for having me. Plastic, right? Credit cards. They can be your best friend or your worst enemy, depending on how you use them. Unfortunately, for younger adults, we see them making lots of mistakes. They run those cards up right to the limit. They are late in their payments. All things, as you know, Brad, that will damage their credit, possibly for years to come. So that's the single biggest mistake I see. Student loans, where folks are bringing on a lot of debt without really understanding what that means after graduation. They're thinking, well, I can hope for forgiveness. Hope's not a strategy. So let's make sure we really understand when we're piling on those student loans, what's gonna happen? What does that mean after graduation? And finally, choice of major. Brad, here's the thing. We spend a lot of time thinking about what school we're going to go to, and that's important. You and I, for example, went to Drexel. Shout out to the Dragons. But at the end of the day, Brad, your choice of major is actually more important most times than your choice of school.
Yeah, absolutely. Look, you caught me off guard with the Drexel mention. You're absolutely right, though. Yes, you've got some tips to help college students make smart decisions with their money here. So what are some of those tips, and how can the students really make sure that they're managing money correctly during that experience?
Yeah, great question. Listen, the first one is pretty self-evident, I think, is limit your student debt to no more than what you believe or expect your first year salary to be. If you're going to come out as an engineer and making 90 grand a year, fine, borrow 90 grand. If you're going to major in basket weaving, Well, change your major. So prioritize emergency savings. At any age, let's make sure we have that rainy day fund. You know, things happen. New set of tires unexpectedly, right? Things like that. Choose your major carefully. And Brad, here's something that I'm noticing more and more with my students. Internships lead to jobs. That is so true nowadays. So snag that internship somewhere between sophomore, junior year, or maybe junior, senior year. Oftentimes that'll lead to a job. Treat it like a dress rehearsal and let it go into a real-time job.
Yeah, thank goodness that Drexel University's Westfall Arts and Design School did not have basket weaving as a major. Otherwise, they could have got this money. You also talk about the best ways for college students to build credit. How can you go about this while you're going through your studies?
This can be tough, but there are tips. So number one, start with a store, what we call a retail card, Target or something like that. They tend to be easier to get, have lower limits, can't get into too much trouble, build your credit from there. Move up to a student card. Most major banks offer a student card that, again, a lower limit, easier to qualify for. There's a couple of really good choices out there. And then gradually move up to those better cards. But the key is we want to build our credit profile as we do that. Pay your bills on time, keep keep your balances low, that sort of thing. Avoid the minimum payment trap. Brad, if you owe $5,000 on your credit card at today's interest rates and you're only making minimum payments, it'll take you about 20 years to pay off that balance. So that pizza you got last night better be epic, because you're going to be paying for it for a really long time.
You also have some tips for post-grad financial planning here. When you're about ready to walk across the stage and then you get hit with the aha moment, like, oh wait, I've got to pay back some of this and I've got to make sure that I'm able to make sure that everything kind of comes to equilibrium with the job that I'm trying to get into as well.
Absolutely. As you leave the quad, think about making a budget. And that doesn't have to be this big, elaborate spreadsheet. It can be, one page. It can be a very simple budget. And a budget is how you and I choose to spend our money. It's really a simple thing, right? Sign up for your 401k plan at work on day one. Don't delay. Time is on your side. Do it now and keep adding skills. Brad, I'm often asked, what's the best investment I can make? It's really simple. It's yourself. Invest in your skills, your human capital. That pays off the best.
All right. I hope that pizza is epic for anybody who's watching this and trying to figure out how they do some financing after it. Dan, thanks so much for taking the time here with us today. Real pleasure.
Thank you, Brad. Take care.
Certainly, you too. Let's do a final check of the markets here. We're approaching 12 noon Eastern time, and we're taking a look at the U.S. major averages right now. The Dow Jones Industrial Average, you're seeing that in the red. That's lower by about 0.3%. The S&P 500, though, and the Nasdaq, they are both in positive territory, fractionally as it may be, holding on to some of those gains here out of the gates here this morning for the front half of today's trading session. I'm taking a brief look at what's driving this activity, and right now, of the sectors that are holding on to those gains right now, financials is leading the pack. Bringing up the caboose, though, is energy. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
time for Yahoo Finance's Market Minute. Stocks mixed. The S&P and Nasdaq moving higher as investors digest earnings and policy changes. Roblox, top trending ticker on Yahoo Finance, shares are sinking, seeing its biggest intraday decline since May of 2024 after reporting daily active users in its fourth quarter falling below analyst estimates. Also, Honeywell shares are lower after confirming plans to split into 3 publicly traded companies. That's amid pressure from an activist investor. Honeywell already announced a spinoff of its advanced materials business. It will now separate its aerospace and automation units. Shares of Apple supplier Skyworks are plunging after the company said increasing competition in the smartphone market lead to a significant drop in sales. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan that QR code on your screen to track the best and worst performing stocks of the session.